Stocks are green. It's Wednesday, April 30th, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Dylan Radigan in Milan to take you through the rest of this hour. Futures market closes at 5 p.m. Eastern. If you're joining us on the platform, joining us on tastylive.com, welcome. Come over to YouTube. Tell us what you're trading, what you think of this big reversal today. Stocks move decidedly off the lows here as we see a market turn around following this first quarter GDP report. A GDP report that's both good and bad. I say both good and bad because the top line number was pretty ugly, minus 0.3%, bucking expectations of a gain of 0.4% according to the consensus forecast. But when you strip away the data, it's clearly tariff driven. The trade figures, net exports, biggest detraction from GDP ever. Recorded data goes back to 1947. You've never seen trade data negatively impact GDP this way before. But you strip out trade, you strip out the inventory buildup, you take out government spending, and you just look at core consumption and business investment, and it's strong, still plus 3% annualized.
Yeah, consumption's at the slowest growth rate in 3 years, though.
Slowest growth rate in 3 years, but you see an economy that's holding on for dear life right now still. How long that lasts is another story. There's still time for an off-ramp before this empty shelves come in, although as President Trump said today, instead of having $30, kids will have $2, and they'll cost a few dollars more. Regardless, though, we see stocks recover, bonds twist, metals down. Ilya, the commodities are telling an ugly growth story there between oil and copper, although oil has a kicker with some news out of Saudi Arabia and OPEC that's worth discussing. The currency markets are jumbled. The Canadian dollar is the top performer. Apparently, Mark Carney calls President Trump and requests a meeting at the White House, which will be occurring in the next few days. In any event, Dylan, I want to start with you here. View from abroad, the U.S. economy is in contraction, Eurozone's growing, our stocks are green. Is this just end of the month, people picking up the pieces after being so far down in the hole? They have to window dress, paint the tape a little bit here as the month comes to a close?
But, I don't know if I'm window dressing and paint or tape painting, although that's obviously, possible. I do think that the market feels comfortable with its level. And I think that much the same as, Tesla, way worse than expected. The tariff madness sort of compromising the sort of perceived credibility of the current administration, and the market's like, okay, well, listen, we're off of our all-time highs, we're off of the recent super lows, and we kind of like where we are. And so I think this is more the market hovering around this midpoint here. Must be the meta number.
Yeah, meta number just came out. EPS 6.43 versus an expectation of $5.25. Q1 revenues $42.31 billion versus an estimated $41.38 billion. Their guidance is a little bit on the lower end. The estimate was for $44.06 billion for 2Q, and their range is 42.5 to 45.5. So strong earnings guidance. Stocks up, and likewise Microsoft here after hours as well. They put up a decent earnings report too. They're offering decent guidance moving forward. Microsoft up to 418 now after hours after closing at 395. Good news for stocks here. S&P 5607 now after hours. NASDAQ 19,757 here. Dylan, as you were saying.
No. I mean, I think that the market likes its level, and I think for me the explanation is less about April 30th or painting of the tape, and more. We knew Tesla was going to be terrible. We knew that tariffs are going to slow down economic activity, and we knew the first quarter was going to be a quarter of contraction because the President of the United States did everything in his power to try to do that and was successful.
I mean, the silver lining for me, Ilya, is that the economy was still somewhat resilient when you strip away the tariff impact. Obviously, you can't just completely take it out of the equation.
I'm not sure I see it that way, because the biggest component of the entire thing is consumption by a huge margin. Sure. I mean, the whole thing is something on the order of 3/4 household consumption. And that was at the weakest growth rate. that we have seen for household consumption since going all the way back to the middle, let's call it second quarter, to be very precise, of 2023. This is a weak set of consumption numbers. This is the weakest U.S. economy that we've seen in over 2 years. And that's coming off a U.S. economy that in the second half of last year, look at the PMIs, was the strongest since 2022. The swing is huge. I don't really look at these numbers as, oh, just strip the ridiculous surge in imports out of the way and everything is fine. And by the way, why the ridiculous surge in imports? Because it's the same story. Because people are front running the tariffs. So that goes away, but not for good reasons.
Who's front running the tariffs?
Businesses, consumers.
Businesses. You get
you're
giant.
saying that you're saying that you're borrowing future consumption even as things contract, basically.
Well, no, if you know that the tariffs are coming, and by the way, you see this in Chinese data on the flip side. If you know the tariffs are coming, you know the trade war is coming because that's what the president campaigned on, and the first quarter is when you need to start to do something about it. What are you going to do? You're going to attempt to stockpile as much stuff as you possibly can at the pre-tariff cost before the tariffs kick in. So, of course,
there's evidence of that, by the way. The data shows.
Yes, of course.
Cut you off, private inventory growth was at its highest level since the first quarter of 2021.
Yes.
And the way that you account for that, you take final sales of gross domestic product, which is GDP less inventory. That's down 2.5% annualized. But that's why. That's why you have to. It's also worth backing out the trade figure and the government spending, because government spending was a huge part of the decline here. But it wasn't because of Doge. It was because of a drag in defense spending, which Doge didn't touch.
Yes.
So you strip out that decline in government spending because of defense, the net trade figure is the inventory, and it's still a 3% annualized growth reading. Which
that was the axe that Pete Hegseth has taken to the pen.
But here's why I bring that up, if only for like a point of intellectual consistency. In 2022, when we had the economy give that initial print where GDP was negative, I was one of the people out there saying, hold your horses, right? This is not necessarily a recession. We have to look at what GDI says. We have to wait 2 quarters, right? And as we get more of the data, we learn that it's not really a recession in hindsight. When everyone was screaming it was a recession at the time. And what I pointed to back in 2022 is if you look at core GDP and you strip away like the noise and look at consumption and business investment, it's staying positive and gross domestic income is still positive. And when you have those things in positive territory, you're not in recession or really, quite frankly, close to it. So for my own sake of being intellectually consistent, I am looking at the same metrics here, and I have to conclude right now, the headline is a contraction. We're not in recession yet. We're getting closer to it. Mm-hmm. We could definitely tilt into it right now, given the mix of the data. Yes. And the clock is running out to turn the ship around and avoid us from slipping into one. But there's enough there where if we get a string of trade deals announced in the next 2 weeks, like that's the window, then you go through a small period where shelves may have a few things that aren't on them for a little while, but it's not really a huge impact, and the layoffs don't come. But we're as close to that edge as we possibly could be in terms of the calendar. Now or never to announce something and get the market and the economy away from the edge.
I suppose if you wanted to take the view that it is possible to strike lasting trade deals that turn this ship around in a hurry with that kind of a speed, which, by the way, is like on the order of unicorns for something like that to occur.
It would be.
Like the fastest trade deal negotiation for the U.S. in recent memory was Singapore, and that was 18 months. And that's a city-state that doesn't really do that much commerce with the U.S. in relative terms. 18 months. So to think that we're going to have a lasting deal here, especially with China, that's going to meaningfully turn around the idea that the average U.S. tariff has increased fivefold in the best case scenario? I mean, maybe, sure. I just think that that's kind of like hoping that mana will begin to rain down from heaven.
Dylan, we have to look to the market action itself, I suppose, as a guide here. We can forget the noise in the narrative. I have a difficult time squaring, junk bonds closing up near their monthly highs, having survived Liberation Day or this month of Liberation Day. Bitcoin is up at the April highs. If we wanted to think about like stock bond ratios, the NASDAQ to TLT ratio is closing the month at a high. Stocks to gold are closing a month out of that. So what's the change in investor behavior? You talk about finding the level.
Yeah, I feel like basically it's repricing the expectation of the Trump administration, which is that they're going to sort of be due in the short term things that slow down economic activity, but also they're not going to crater economic activity to the degree to which everybody feared at the beginning of April, because they don't really do what they're a lot of talk, basically. But the type of talk that they specialize in is the kind of talk that slows down economies, and that they're not entirely talk. There are actual tariffs right now, even if some of them may be short-lived. And the market is like, okay, we like 5,500. We don't like 6,200. But we think 4,800 is crazy.
That was liquidation territory.
So we'll trade around 5,500. I just think that the market is reflecting as adapted. Like the market was not prepared for what happened at the beginning of April. No one was. And then, like everything with Trump, you can't be not has nothing to do with Trump. Like anything the president of the United States does, you have to take it seriously, at least for a minute until you can get a better handle on it. I think the most interesting trading situation, I think oil is the opportunity of the moment, actually, because unlike
on the long
equity
side
market, which is on the long side, yeah.
Well, I suppose it's worth giving an overview of the news today. There was reports out of Saudi Arabia after we get the GDP report. And I suppose we need to start there. Why does oil react negatively to GDP? One of our favorite stats to cite here on Overtime, the correlation between demand for oil and global GDP on a quarterly basis over the past 30 years is plus 0.93 right now. So weaker growth from the world's largest economy typically translates into less demand for oil. What do we hear today, though, as we have in news or indication that demand is softening in the world's largest economy? We get a report from Saudi Arabia, one of the world's largest oil producers, that they're willing to eat lower oil prices for an extended period of time if necessary, which comports with a discussion from last week here on the show when we were talking about how Saudi Arabia seems to be positioning itself willing to try to take market share from American producers, because below 67 to 71 a barrel, you're not going to get new wells. And if you dip below 49 to 53 a barrel in WTI, you're going to start to see existing wells in the U.S. shut down. So Saudi today signaling to the world, we're happy to play the game. We can stay solvent longer than you can. And a few months of oil below 50 maybe takes out some competitors, maybe takes out some producers, and ultimately clears the path for a greater market share over the next 5 or 10 year horizon. So oil is not liking this weaker demand, more supply combination in today's session, but it's an 88.5 IVR. For all the kvetching that we've done here on Overtime about no volatility in oil, the monkey paw curled and gave it to us in a significant capacity. Dylan, before Ilya jumps in and explains, his bearish perspective on oil, I'm curious, what is your contrarian view?
I think, because I'm as you know, I'm pretty skeptical of the degree to which Trump will follow through on wanting to really crater the global economy with all of his tariffs. And so I just think that I think there will be these tariff deals. I think oil very clearly is expecting a recession, and beyond that, a global slowdown in general. And I just think that its pricing is such that there's probably of all the big financial instruments, this is the one that strikes me as having a price. I won't even call it a price extreme, but a price level that catches my interest. Much more interested in being long oil short term than I am in trying to pick a side of the S&P 500, for instance.
Ilya, if I may just opine on the price level here.
Sure.
Well, if I may opine on the price level before you jump in here, we had been watching this potential head and shoulders pattern on a short-term time frame in oil, and I know that you've been leaning short here. So that potential extension,
I still am.
Left shoulder, head, right shoulder. A simple measured move gives you a downside target close to 58. It's also near the swing low that you have on April 10th, and that is effectively completed today. So if you think that this was the driving technical force, there is something to hang your hat on to try to play off of this low. But why don't you think this is a good place to try to play for a bounce?
Because I think if you want to understand what oil did today, I think really the cross-asset story really explains what the market's made of this data. And it's why I'm so skeptical of the rebound in stocks. You very clearly see GDP on this screen. Right? You see that big red candle there?
So
That's
this is
GDP.
Okay, we're going here. We're going to, this is ADP right here at 8:15. Yeah. Okay. And then we have GDP here at 8:30. And then we have
the GDP is that big red candle right there. Yeah. That's it. And that was the start of the drive for stocks lower as well.
Yeah, we have the OPEC announcement is clearly the harbinger of doom here today. 11:40 a.m. Eastern time. That's when we get our big OPEC or Saudi Arabia news dropping. So the ADP report showing 60-something thousand jobs added doesn't help. The GDP report doesn't help. No. And then we get the OPEC announcement, which is like, oh, we're going to flood the market with supply.
Right.
And then, okay, now the two things keep oil lower. We try to recover through the post-GDP swing lows here today, back above 59. We really can't do it.
Well, and now take a look at copper. Because all of this starts to add up.
Copper was a little, well, not a little. It was a lot of bad today.
Overnight. Copper was a lot of bad today. And again, it's weak Chinese data overnight. It's soggy Eurozone GDP. It was a little bit better than expected, but still within a very kind of anemic range that's held for over a year. And then you get US GDP and you get smacked again. Then you look at the front end of the curve, ZT. Obviously, many more rate cuts being baked in. Because again, you see as the data gets ugly, you likewise start to see kind of the atmospherics of recession.
The atmospherics of recession are certainly there. The sector performance today wasn't fantastic across the board. It obviously recovers by the end of the session, but discretionary is still one of the underperformers here. Leading the way higher, biotech, GDX, GDXJ, home builders, healthcare, staples. On the downside, oil and gas, sure, we'll forget that for a second, but KRE, consumer discretionary, retail, telecom. Dylan, it wasn't a clean flush. This is one of the more. It's not a growth day in the market. Stocks are up right now, and we're squeezing higher in the short term. And I guess I'm having trouble reconciling, and I'm curious what the chat thinks here. Part of my head says that the economic reality has yet to bite, and it's still barreling towards us. But it's not set in stone, and there are certainly opportunities for off-ramps that could happen at any time. The other part of me thinks that, Dylan, this is kind of like Tesla last week and the week before. We know this is coming. Everyone knows this is coming. If you don't think this is coming, you haven't been paying attention. Everyone and their mother at this point knows the tariffs are coming, the growth is going to be lower, the inflation is going to be higher. Anyone who's read an Econ 101 textbook knows how this stuff works. So when it occurs, are we all going to be shocked and surprised? I mean, that's fundamentally different than 2008, right? 2008.
Hugely different.
Like we're like, oh yeah, Bear Stearns collapsed. Well, JP Morgan bought it. Like, stuff doesn't hit the fan for 6 months later. The VIX spike isn't until July, August that year, Ilya. Lehman doesn't go down until September.
July 15th, as a matter of fact, if memory serves.
You know, we could be in a market where, because we don't have the actual economic data, there is a sense of relief where we kind of burst to the upside. And then you're saying
3 to 6 months from now, it's gonna be a holy shit kind of situation, and we'll look back to the first quarter as the sound of the missiles, and then the impact is 3 to 6 months in the future.
Well, Ilya, wouldn't that track? Like, when will we actually see the data that shows if there's? We have the stories in the logistics supply chain right now. People can look this up themselves. They can go on Twitter and follow any of the number of people who work in freight there, and it's like their world is on fire right now.
I mean, look at the PMIs. The PMIs have been god-awful since the beginning of the year. This GDP result was very clearly telegraphed in S&P Global PMIs, January, February, March, going into April. They showed the upswell on the manufacturing side because people were front-running the tariffs. They showed that the service sector was catching a cold because of uncertainty, which is telling you that the biggest part of the economy, 75 to 80%, which is services, and which isn't necessarily impacted by the tariffs directly, because most of what we import is goods, that is starting to crack just on the atmospherics alone, on the uncertainty alone, and on what that will do to consumers. So it's not like any of this is particularly novel, but also, all through the course of April, what did we have? A sovereign crisis in the U.S. in the wake of a mini sovereign crisis, in the wake of the Liberation Day announcement, where U.S. stocks, U.S. bonds, and the dollar all sold off at the same time. Then we found the put in the bond market, where, you know, once you got to, let's call it 4.5 on the 10-year, the president backpedaled, not once but twice. And so now we've unclenched that. Okay, but the recession is still on. It certainly looks closer now than further. And so now that the sort of spike drop, spike bounce of maybe the U.S. is having a sovereign crisis, wait, no, it's not. Now that that's past us, in my mind, we go back to where we were mid-February to the beginning of March, which is a steady, recession-minded, there's a growth downturn kind of a thing. Stair step down. No panic, just adjusting to a weaker level of growth. If you pretend here on the chart that April doesn't exist, then this is just rebuilding to the same, more kind of measured dynamics of the down move before that. It is a re-engagement of that less aggressive down move, if you will. Because all we have, again, if you take the sovereign spook off the table, all we have is just more evidence that what you saw in February and in March continues in the same direction.
If we take the sovereign spook off the table, that's a hell of a candlestick, Ilya.
Yeah.
That's a month, Dylan, that's a monthly candlestick for the ages. This is the first time ever that the NASDAQ's been down more than 10% in a month and closing positive. The NASDAQ, with today's close at 4 p.m., not accounting for what's occurred here after hours, granted, plus 1.51% for the month of April.
Amazing.
Dylan, this is the hardest. This is again why I'm having such trouble reconciling these things. And Ilya, you have to forgive me. The numbers themselves don't matter. The market reacts to the numbers is what matters.
Of course. I couldn't agree more.
I'm using your words to almost push back on you a little bit here with the bearishness.
Sure.
Because this was the discussion earlier this week with Tom and Tony, right?
Sure.
Like if Tom's whole shtick, which I never really appreciated and understood, but now I understood what he's trying to say. I wouldn't say it the way that he's saying it, but like if someone gave you the numbers for non-farm payrolls, you wouldn't know how the market's going to react to it.
Absolutely.
Right?
Because you have no idea.
Because it's not the number itself that matters. It's the sentiment and the story and the narrative and the positioning
the expectations and what the price action tells you the numbers mean.
Okay, so then the price action here, that's a hell of a
stock markets are not the only markets though. This is the essence of what I'm saying. Of course, stocks had a blistering rebound. There is no question. But that's because, of course, the idea of a sovereign crisis in the U.S. is bananas. Even if the U.S. were to completely fall apart, I mean, that would be a world-ending event because there is no alternative. So no matter how bad the U.S. gets, it is still the least bad option because it is the only option that's on the table that's comparable for depth of liquidity, for the dollar, and the Treasury market being sort of baseline for what is riskless borrowing, riskless in quotes, obviously. That's fine. But even just today, what you don't see is what's happening in stocks any place else. You don't see it in the growth commodities. You don't see it in the bond market. All of those things are telling you a different story. So then you turn to stocks and you say, well, why are they doing what they're doing? Why is it that stocks don't buy what clearly the bond market and other markets are saying? And to me, it makes sense in the sense that, number one, stock markets don't like going down. They are fundamentally biased because the largest participants in stock markets never, ever short. And we're talking about endowments and pension funds that hold until the end of time and are the largest owners of U.S. equity by far. And the other thing is we have a ton of earnings this week. Who is going to jump out the window and commit when you have Microsoft and Meta today, you have Apple tomorrow? The markets have an excuse, stock markets have an excuse. But that doesn't reconcile with the price action elsewhere. So if you're going to go by the price action, you do not have a convincing bullish story here telling you that what stock markets are saying is they've shrugged off the cyclical risk because they're the only ones. Everywhere else is screaming, this is a recession.
Dylan, Ilya has a point about the other assets. So who's right? Is it oil and copper and bonds? Or is it the stock jockeys?
I mean, history has to put you with oil and the bonds, more bonds than anything. I mean, bonds is just, by definition, the most price discovery and intelligence on future economic. The purpose of the bond market is to price the future value of money and growth and inflation and risk, right? I wonder if you can reconcile the two different signals with the belief that the economic slowdown is here. It is not coming. The first quarter GDP shows that it's already here. And it's not that bad.
Bloomberg reports that
it's mild.
The EU will present its trade proposals to the U.S. next week. Memorandum of understanding coming together the next week or two between Europe and the U.S. wouldn't be a bad thing, Ilya, would it?
No, absolutely not.
Right, I think that's, there's some other comments here from the administration. Kevin Hassett, who I don't know what service he provides to the country. He says that he thinks that the GDP data will be revised. Yes, it will be. I can tell you the exact time and date it will be revised, Kevin, because we do this every month.
3 times, by the way.
And in fact, we know exactly when the next revisions will be out because it's on the calendar already. Thank you for your help in the cause of informing the American public about the state of the U.S. economy, Kevin Hassett.
Well, listen, he's not had a really great track record. The president keeps contradicting him, so I guess he went for mastery of the obvious, which is the safe choice. If you want to be generous.
If we're going to take the Kevin Hassett card seriously, we actually should probably make a market on whether or not the GDP data is actually revised in the future. Maybe they just cancel it now because he seems to be wrong about everything. 56.23 here, so it's a 0.7% gain. We're continuing to rally after hours. The EU trade deal talks, that's a good sign. I wonder if someone heard about that before the close, Dylan, because the market was rallying before the close. Microsoft and Meta earnings both beat expectations, and the guidance isn't bothering too many people here. Microsoft trading up now to $4.19, right, holding on to those gains after hours. And by the way, trading at its highest level since January 29th, looks like.
Right.
January 30th.
And this kind of possibility is exactly how I arrive at the idea, well, who in their right mind would want to be a big size seller of NASDAQ before these kinds of announcements? The risk is too great. There's too much that's an event-driven concern there if you want to be bearish. Why would you do that? I suspect this resilience probably holds through Apple. But then give me a bad NFP report, and not sure that there's any more resilience left.
Dylan, Meta's up at 578 right now. This is a really fascinating spot for it to have turned. The former highs that we had in July and in August last year. We find ourselves today poking above this level, and as we go down to that 12-hour time frame, you can see that we're really skyrocketing off of it, breaking the downtrend that's been in place off the highs for the past few weeks. Are we in the clear? Meta's been one of those names that's been on our docket for a long time here, liking it. It was one of the 2 companies that I wrote about in the early April slide. Like, if you liked it before the soft, what do you still like now? Meta's working well for us.
My inclination is to say yes. I mean, I'm not surprised. I think the more significant thing, I think that I actually think, well, while it's not getting the discussion, I think that artificial intelligence is going to have a massive year. And I think Meta is one of the greatest beneficiaries of that. And I think that the talk of a European or an EU trade deal next week is in line with what we've been expecting, basically.
Ilya, how does this all go wrong? Is it that they don't get the trade deals announced or indicated or off-ramps before the ships stop coming into the ports, before the shelves are emptied, before the layoffs begin? Is that the risk?
I'm not sure what kind of a trade deal in practical terms you can have on this kind of speed. You could have a memorandum of understanding, perhaps, and what is that going to do?
Let's just say no tariffs, like
no tariffs
during this
back
window.
To 2%.
During this window with which we're negotiating, tariffs will be at the rates they were prior to January 20th, 2025.
That would be, I think, a tremendous positive. It would also engender exactly the kind of uncertainty that the markets are afraid of. Let's not forget, the problem here isn't tariffs. We've said this said this over and over and over again. If the markets were concerned about tariffs, they would have sold off in November. They're not concerned about tariffs. They're concerned about chaos and uncertainty. If the markets knew what the tariff rate was, and they had some semblance that there is a regime that's durable, then they would make the necessary adjustments. Because these adjustments can take years to make. And what the markets want to know is how to make those adjustments. Do you begin reshoring? Do you then build factories? Do you change supply chains? How in the world would you do that if you have no idea what's going to happen? Never mind 90 days forward. You don't know what's going to happen in 48 hours. So the issue here is, okay, you get a memorandum of understanding, you agree to talk. For how long? Indefinitely? Okay, that would be good. If you got some sort of a complete off-ramp on this entire thing, which is incredibly unlikely, but if you did, and you said, okay, you know what? Name me the top 5 U.S. trading partners, right? Like EU, China, down the list. We're going to go back to an average tariff of 2% while talks are ongoing and there's no deadline. Okay, great. That would be very meaningful. What is the likelihood that that's going to happen? But almost zero. So if you get another fixed cliffhanger, like you did with the pause of the Liberation Day stuff above 10%, and that's important because 10% is 5 times the tariff before that, which was 2 on average, which is incredibly damaging already, just by itself. But if it's another cliffhanger like this, there's no more certainty. And there's no reason for consumers to get particularly optimistic or for businesses to get any more certain. So where's economic activity going to come from? Then you have the scenario where, okay, indefinite pause, but not at 2%, at 10%. Have you fixed anything? No. Tariff's still 5 times greater than before. So, yes, it's possible that pigs fly and magic is real and you go back to a 2% tariff without a deadline. Mm-hmm. But how likely is that? Not very.
I mean, I know how to make a coin disappear in my hand. I can do that trick. So magic is real. So your argument already has a hole in it. Not to dismiss what you're saying, I do want to point out something in price action today. Mm-hmm. We talk about the effects and the bullwhip effect of things yet to come, economically speaking. The last time that we had the S&P 500 erase a 2% decline intraday and close positive was the day that I have highlighted here in the chart right now, October 13th, 2022. That was the low for the market for the rest of 2022. That was the end of the bear market. That was when things started to get spicy and it became prudent to start looking long. The Fed did not end its rate hike cycle there. It continues to hike rates over the next several months. Right, Ilya? We have our little kerfuffle in March of 2023. The Fed looks like they might have to cut rates, and Powell comes out a few weeks later and does what? Hike rates again. But stocks, after that turnaround on October 13th, 2022, they were able to rally, even weathering the March storm. They were able to rally through it all, even though the economic pain didn't come. That just happened again today, and I don't want to dismiss that, right? We had the Zweig Brett thrust last week. Whoever heard of that before last week? But we had that last week. We now have a 2% intraday turnaround in the S&P 500. That the last time we saw something like that was the low in 2022, and inflation didn't die then. Inflation was still a problem. Dylan, I feel like the market's telling us some things in the price action that if we didn't have this tariff overhang, if this was in 2023 and this was the action in the market, breaking the February downtrend, bouncing off the 1-month moving average, volatility comes in, swag breadth through, I'd be bullish. Sure. I'd be bullish to the hilt.
Well, if ifs, ands, and buts were candy and nuts.
I mean, do we need to just stop worrying?
We do have the tariffs.
But do we need to stop worrying and learn to love the bomb in the short term until it explodes? Dylan?
I mean, the short answer is I think yes, and that was why I was, but for me, that's why I was attracted to oil, honestly. Only because oil has not bounced off of its lows. But I was just using the same argument that you were just articulating so brilliantly, to the point where Ilya has no choice but to come around to our way of thinking. That's why my thinking was do this in oil. And also, by the way, buy the dollar. I think the dollar gets a little bit of an improvement here. Those are the two things that I'm attracted to right now. I buy the economic strength story, and I think the two opportunities are long dollar, long oil, more than some wacky position in U.S. equities.
So this is an interesting animal here for sure.
Did you see what Jared Delanian tweeted today?
I did not.
So he's a Bloomberg. He's obviously a writer, Daily Dirt Nap newsletter. Definitely.
Jared Dillian.
Dillian, yeah. He's a great writer. You know him. You've been following him for years. Ex-Lehman. Yes. He writes for Bloomberg Opinion sometimes. Definitely check him out if you haven't read him before. I point out his tweet today because on January 6th, he tweeted out something to the lines of, I've never been more bearish on the dollar in my entire life. And today he tweeted out that he's bullish on the dollar again. So not that he's anyone noteworthy, but when someone makes bold public calls and they ended up being right, and then they flip on that call, it draws my interest because they clearly have a good pulse on whatever market or product they're examining. The euro did not rally on a day where Eurozone GDP was strong, 0.4%, and US GDP was weak at negative 0.3%.
Slightly stronger than expected, yes.
Can I bring up a news story that really piqued my interest today about Europe? A few weeks ago, they talked about raising a 65,000 person defense force, the deterrence, to be placed in Eastern Europe so that they could hold the line in a Russia-Ukraine ceasefire. A report came out today saying that Europe doesn't think that it can get together 25,000 bodies in the window with which it needs to assemble this deterrence force to keep Russia and Ukraine from conflict with one another. So what kind of world are we heading in where you really think that the euro is going to be the new reserve currency? And if we are stepping back from a brink of the market having adjusted to sovereign credit level risk for the U.S., then what's the most likely near-term path forward for ECB versus Fed policy? I mean, the reason why I bring up core GDP is because I don't think there's anything there that allows the Fed to cut still. Whereas Europe is going to be facing significant export issues with a euro that's this strong. And now they have a central bank that has its hands tied at a moment when the continent really can't get itself together, when it really needs to get itself together. So perhaps the dollar reaction today, again, not being cooked on a GDP report that should have absolutely cooked it, stagflation is coming down the pipeline, that's probably a tell. I would almost feel more comfortable being short the euro than getting long stocks for, say, the next 3 months if I had to place a bet on it. Not that I'm going to do that, but I would feel a little bit more comfortable being long the dollar than the equities here moving forward for the near term.
I mean, I think there's an interesting argument to be had there. And from Europe's perspective, getting the manpower they need is going to be tough, and they're getting cozier with Turkey because they realize that they do have the manpower and they're a NATO member, and that can be done that way. And some of the less democratic things in Turkey are getting kind of conspicuously overlooked, let's say. President Erdogan's top political opponent in this upcoming election was jailed, as were many of his allies, on charges that nobody really takes seriously.
That's crazy. I can't believe it. In Turkey, of all places.
Yeah, shock of shocks. But Europe is being very cagey and mum on all of this, but for some performative statements, largely because this is how Europe ends up with the soldiers that it needs, is it gets them from Turkey. But the upshot is that whatever may happen here with getting the number of soldiers, before you ever get there, what you need is the buildup of hardware and the buildup of everything else that has to go into what those soldiers are going to actually use. And very tellingly, if you look at what's going on here, the market is still flirting with the idea, about 50-50 shot, that the ECB hikes next year. Not cuts, hikes. There's 11 basis points of a hike that are baked in for the ECB next year. Whereas, I mean, maybe you're not convinced, but the markets certainly seemed a lot more convinced in the case for easing from the Fed. The outlook for next year is now 43 basis points in cuts, and the outlook for this year, 95 basis points. So we're looking at 6 rate cuts, basically. Where at the beginning of the year, we looked at maybe 2.
So square this with me. We talk about cross assets, and to be clear to the audience, because I've seen some people say like I'm unfair to you sometimes, Ilya, and I think that's
all
also,
the time.
Dylan, I've known Ilya.
Okay.
I've known Ilya for half my life. I got my first internship at the company that he was working for when I was 18. I turned 36 in July. Okay, so Ilya and I have
a long time.
We have some good rapport. We have rapport.
What's that supposed to mean?
We have rapport, right? I can give him a hard time.
Ilya has suffered longer than he ever expected.
We speak in an unvarnished way, is what that means.
I go through the exercise of asking these questions because I'm trying to sort through this information out myself. And so the way that I was raised, like my parents always told me as attorneys, you approach situations, try to steel man it, which I know Victor tries to do with Tom a lot. But
sure,
present an argument as if you were, if I'm going to go to court, the best way to prepare for your case as a prosecutor is to prepare for the case as the defense.
To run the defense.
Exactly. So I'm trying to suss through all of the pros and cons here of what's happening right now, because I can pick a narrative. Canadian dollar's closing at the highs today, Ilya. You and I have long discussed how this is a canary in the coal mine for the broader U.S. economy because Canada is so dependent on our growth. 80% of their exports come to us. So a Canadian dollar that's closing at the yearly high after a GDP report in the U.S. that contracts after all of this trade talk, trade war, tariff nonsense, tells me that the market is also saying that maybe U.S. growth, maybe we're at past peak concern. Crazy?
Yeah, because Canada's economy hasn't benefited from a robust U.S. in 9 months. And that has severely severed this connection, and it's because that's because what's been going on in Canada has been abysmal, basically since the beginning of last year economically. Meanwhile, the U.S. was booming. How did that happen?
Canada's been abysmal. That Canada has 0% real capita GDP growth since Trudeau took office. We got to be honest about that. Canada has not had significant growth.
Are you saying that there's not a reason to at least be short the Canadian dollar here on oil prices in the tank? The tariff wars are the worst of the tariff wars is behind us basically, and the price move up is where it is. I mean, I feel like I can make a better case for short the Canadian dollar than I can for short the euro.
I mean, maybe. I don't think what you have in the Canadian dollar is a price signal that looks attractive from a risk-reward perspective, though I see the makings of what could be a short here eventually. If you got some confirmation, we're testing some important resistance here. There's topping signs in the yen. There's topping signs in the pound. There's topping signs in the Aussie. The dollar looks like it's either consolidating in a tricky way where people are starting to think it's going to rally and then get rug pulled, or it really is a top in a lot of these currencies and the dollar claws back here. We'll see. I'm not ready to take a directional bet on the dollar. I mean, obviously, I was short a lot for the majority of this year. In fact, that's been my best bet so far this year. But I've been out of it for, about a week now? And that's fine. I don't see a compelling reason to jump back in. I think to Chris's point, the idea that Canada is a bellwether for U.S. growth maybe not being that bad and being up isn't something that resonates, because Canada hasn't been able to make anything of robust U.S. growth all of last year. And it's because that robust U.S. growth was in the service sector, and only the service sector for the most part, and that's mainly serviced by domestic firms. It's why Europe couldn't get out of its recession or near recession last year. It's why China couldn't build any momentum, because U.S. demand was not spilling over. And it wasn't spilling over because it wasn't in goods. It was in services. So I just don't see how what the Canadian dollar is doing here is emblematic of anything about the U.S. That relationship has been disconnected for a while. Also, they just had their election, and so the political uncertainty is off the table. And as Chris just illuminated for us, there seems to be some kind of a rapport between Mark Carney, now the confirmed Canadian Prime Minister, and Trump. They seem to get along, much as Trump and Claudia Sheinbaum get along. So could that be what's going on in the Canadian dollar? I mean, maybe. Sure. I just don't think it says anything about U.S. growth.
Canadian stocks are closing at their highest level of the year here today. You look at this chart. This kind of looks bullish to me. I don't know. That kind of seems like a flag where we had a breakdown and now we've swung back to the prior swing high. Ex-US, the world is looking pretty decent right now. One of the bigger misses that we had earlier this year, but thankfully amended our wrong-thinking ways, was on Poland, which is still one of the world's top-performing ETFs with all the European defense spending going on. We can go over to Germany, likewise. It's had a nice little bit of a rebound here. Not the highest close of the year, but looks like the second highest close of the year for German stocks. Got to do a lot of processing here tonight to make sense of all this. There's some definite signs in the price action that are encouraging. There are definite signs in the price action that are not encouraging. There's good things in the GDP report that give you a glimmer of hope. There's definitely some garbage in the GDP report that makes you very fearful. Today was also the end of the quarter. We had decent earnings from Microsoft, from Meta. So it's been a fun little stew here. I suppose what's of interest to me is that I got off the short gold train today. And I have flipped back to long. I have flipped back to long in part because it looks like we're trying to squeeze ourselves outside of the downtrend that we've been in since the high last week. We're holding up some support here around 32.50. We bounced off of it today again. If we're going into recession classic, bonds and gold do the best. And there seems to be right now a place to operate around. So if we do break below 32.60 or so, I'll get out of the new long that I put on, but I'm playing for a move back to the high. Long the 3,500, short the 3,550 call spread once more. Gold should be a lot weaker than it got if my perception on a pullback was going to be correct. And it's just not making the move downward. So I don't want to miss the move to the upside were it to occur. I think we can have a recovery in stocks in the short term with gold prices chopping around and moving up. And there's just a lot of candles where you see support around 32.50, 32.60. So I'm back in, Ilya. I couldn't resist it. And I'd be a lot more upset if I was short gold and it went up than if I'm long gold and it goes down because of my prevailing bias. So I don't want to kick myself. Yeah, just I know my mental shortcomings. That's going to bother me. That'll bother me a lot more.
Oh, sure.
That,
I totally agree.
Dylan, Ilya, can I tempt you guys on something with gold now after it's been, $250 off the high and has settled in a little bit here?
Lay it on us.
I mean, I'm getting there.
All-time highs. All-time highs before the end of the second quarter.
I'm getting there.
Hell, before the end of May.
It's holding this support. Let's call it 3260-ish, 3300, the range. Show me some signs of life to breaking out of this range, so get me back to like 3350, 3360, and I'm with you.
How can you want to play gold on a reversal? Be feeling like if it wasn't for the tariffs, you'd want to get
rate cuts
long old school.
I think rate cuts are coming.
I couldn't bribe you into a barrel of oil.
I'm sure. These are fundamentally different things. One is growth related, the other is rates related.
Well, hold on, Dylan. I didn't realize bribes were involved in this. You could absolutely bribe me into a barrel of oil.
All right, then we'll meet off. We'll meet at the bakery in Bedford.
Please, thank you. Yeah, if you have some barrels of oil to sell,
cinnamon rolls.
That's fine. My kid is, that's like her primary source of energy these days.
Good.
Yeah, I'll sell you oil. You give me those little frozen rolls.
Anything you want. You to tell her to write it down.
So I do need to end here on an editorial note.
Letter.
Our boss here, guys, Tom Sazov, got a letter saying people believe that we're anti-European because of our remarks about the standard of living in Europe. There are data points to confirm the perspective that Europe doesn't have ice or air conditioning. In fact, as of the end of 2022, 19% of European households have air conditioning. Fewer than 60% of European households in Germany and Switzerland and Spain have refrigerators. And less than 10% of European households have ice makers in their refrigerators. So no, I don't just say these things. My perspective that Europe doesn't have ice is actually well-founded. You don't need to email Tom Sosnoff about it. Feel free to do so. He enjoyed.
I completely disagree. That was an exploitation of the clock. I will rebut in a future time.
But overtime's out of time, unfortunately, for this Wednesday, April 30th. We'll be back tomorrow, same time, same place, 4 p.m. Eastern, 3 Central, right after last call.
I'm going to go turn on my air conditioning right now, just to spite you.
Oh, look at this wealthy European over here.
Okay, now he's going that way. Okay.
For Dylan Radigan, Ilya Spivak, I'm Chris Vecchio. See you tomorrow after a brief break. Macro Money up next here on Tasty Live.
If you missed the live show, here's our cherry on top weekly recap.
Matt, how about you? What did you get up to last night? Any shenanigans?
Watched a little hockey. Watched my pool get filled up with water.
That must be exciting. When it goes to each level, what do you do?
We have a party.
You have a party?
Have a party.
Do you fill it with cold, crisp bottles of Saratoga Springs?
No, you use Fiji water, don't you?
Evian?
No. Hose water, Sosnoff, so I'm going to tell the kids not to drink it.
All right. Put up this picture. Can you please put the picture of me as an action figure? It looks like...
put him in a tracksuit? Is that tracksuit?
Tracksuit works. I don't really have tracksuits, but I do wear a lot of leisure stuff on the weekends, so I'll be good with the tricolor cookie is absolutely spot on. The coffee cup is spot on. The trading card is spot on.
It's a pink sheet, yeah. Like a
disco ball, I can handle it. What I have a problem with is, how did Dylan Radigan get in my jeans? It looks like a collab between Tony and Dylan Radigan. It looks like Tom. Like, that's Tom. I mean...
That's because I did this one.
Right, that's Tom as a gnome. You're perfect. You did you, right?
Of course I did me.
Yeah, of course. I could have told you that.
So I have a can of Diet Coke. Liz and Jenny.
Can't say anything bad about that.
They have the zebra and the jade lizard. Jenny, of course, has a glass of wine. I did Jenny's. And her boat, her sailboat.
Yeah. You were very kind.
Also, I'm no dummy. I typed in the prompt, make her look younger and slimmer. I did Dr. Jones. So he has the dumbbell, a cold plunge pool, a calculator, and he's Florida man.
Jamal, perfect. The basketball, the football, the video games.
And the gears, because he's an engineer. Yeah, I did Julia's.
Yeah, perfect. She looks
She's
great.
the cat. So the thing, people think it's a chandelier. It's a quantum computer.
Mikey Butler's perfect.
Yeah,
Very
he's got the
good.
snowboard, the Chinese takeout, the dumbbell.
Yeah,
golf
perfect.
ball.
Mikey must have done Mikey. Let's go next one. Okay, who did my son dirty?
Was not me.
Okay.
It was not me. The same person that did yours did your son's.
Okay, they don't like Batista, so that's what I figured from the very beginning. Katie McGurgle's beautiful, perfect.
Katie is stunning. She is an icon. She has a Harry Potter wand, cowboy boots. If you haven't seen Katie try to teach Tom how to line dance, it's on our social. And then
Okay, now I know who did the Batistas. It's Gus. Okay, Gus did the Batistas. All of a sudden, he's all buff and What the? This is not. This is. Gus did the Batistas, I'm 100% sure. And Gus, I will be coming for you.
I should have been. This should have been me.
Yeah, he looks like The Rock. Yeah.
Mommy and Daddy are fighting, okay? And you guys are not getting along. I am not going to come in here and try to mend this broken bridge.
He's just having John withdrawals, that's all.
With you, it's hard.
She always has her A game. Wait, go ahead. I'll take the pressure. I'll take the heat. What do? I love this.
What's the line you always use? It's hard to fly like a turkey.
Fly like an eagle. It's hard to soar like an eagle when you're working with turkeys. Turkeys don't fly. We're like, I cannot with him. I just sometimes.
Wild turkeys
Did you just
fly.
call me a turkey?
What's that? Wild turkeys do not fly.
Yeah, Steph. I think you and
Did
me.
you call
I
me
think
a
this was
turkey?
more.
I didn't call you. I'm calling
No, I think
Scott.
Turkeys
it was
don't
me.
fly. They can get airborne for a second.
I called him a wild
fly.
turkey.
You can get airborne. Well, you couldn't get airborne.
Turkeys
for anything.
fly. Turkeys fly. I've seen turkeys fly.
Turkeys do not fly.
A wild turkey doesn't fly, you're telling me?
You've seen a turkey fly.
When Tom's out on those survival missions that he frequently goes out on with just a knife, and he hunts.
When I'm
he
taking a
sees
hike
wild
in the
turkey.
woods, I've seen wild turkeys flying all over the place.
Get the full scoop by checking out the archives at tastylive.com.
Tom, when you're scooping the offer, what are you doing?
That means when you're scooping the offer, you are buying whatever you can get your hands on at the best available price.
What does it mean when something trades by appointment?
Trading by appointment is when, like, you're in a pit back in the day that had like one or two market makers in it, and if they were having lunch, you had to make an appointment to make a trade with them.
In the pit, if you said, I'm going to buy your book, what did you mean?
If you're going to buy the book, that means you're going to buy everything that is posted in an electronic book. So every resting order that's posted in the book up until a certain amount.
If you say take a fill, what's happening?
If I'm taking a fill, that means I'm a broker, and if I'm a broker, that means I did something horribly wrong because I'm a market maker.
With a big earnings week coming up next week and a time of really heightened volatility, what advice would you give to traders in terms of managing and attacking earnings in a time like this one?
I think this one in particular, just given the market volatility, I would be a little bit more conservative with the trades. Maybe instead of going a 10 or 20 point wide iron condor, go to a 5, because the market has been moving huge in both directions. There's tons of opportunities. There's no shortage of trades out there. I think earnings trades should be kind of pushed to the back burner in terms of your risk parameters.
What type of specific criteria do you look for in an earnings trade, and does that change in a time like right now?
Well, the main criteria is, of course, volatility, but you've got high volatility everywhere, so you'll have no shortage of high volatility to trade. I would say maybe going a little bit further out in time this time around, going into the May or the June monthly cycle as opposed to the weekly expirations, just to make it a little bit less volatile from a P&L standpoint for your positions.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
If you have any questions, feel free to toss them in the chat. Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The U.S. economy unexpectedly contracted in the first quarter. But as we look at the makeup of the report and then what the price action did with it, questions emerge about just how worried we should be. And of course, the markets managed to reflect exactly what the confusion seems to be, or maybe something else. We're going to try to unpick what's going on here. This is Macro Money. I'm Ilias Spivak, head of Global Macro here at Tasty Live. And what we're going to try to make sense of here is what exactly the data told us, not only out of the U.S., but an avalanche of data, in fact, overnight from the world's major economies. And then see if we can't unpick what's going on here, not only with the situation in the global economy, but also in the market reaction to what seems to be going on here, because it does seem to suggest that perhaps at least some of the market is not prepared to say that the worst is here, or maybe a different explanation presents itself. And so let's go through here and see if we can't make sense of what today's price action appeared to offer. We begin first and foremost with a look at some data coming through out of China. We can see here the PMI numbers marking a downturn for April. We, of course, had numbers for the other major global economies published last week, and this kind of rounds out the story. And what we find here is that the world's second largest economy is basically at standstill. Now, this shouldn't really surprise anyone. The GDP numbers for the first quarter that came out continued to show the economy in its 8th consecutive quarter of what is essentially economy-wide deflation. The situation has not improved on that score, and so perhaps no surprise here. But nevertheless, the situation pointing to weak conditions, and in fact, those conditions weakening. The manufacturing sector in particular slipping deeper into contraction territory. As always, of course, PMI numbers are looked at around a center line of 50, where above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And we can see here that the manufacturing sector here contracting and at a brisk pace, while the service sector slowed. And so the upshot for the composite PMI was standstill. We've returned to standstill once again. We've hovered near standstill for a while now, and we're essentially at the lower end of this kind of anemic range that has characterized China's economy, basically going all the way back to where the bounce from reopening after COVID restrictions fizzled in the first quarter of 2023. Then we get Eurozone GDP data, and it is a little bit better than expected, 0.4% versus 0.2% expected. And that is perhaps to some extent encouraging, but it also just lands us near the top of the range that we've occupied really since the beginning of last year. And so the upshot seems to be that the Eurozone's economy is no worse, but no better than it's been. So at least whatever issues may be coming up here, they are not getting necessarily worse in Europe, and perhaps at least there we have something of a bright spot in the overnight news flow, but that really is about it, because later, in just a few hours time after this, we get the U.S. GDP report. And here we get the first contraction in GDP in 3 years, down 0.3%, versus a rise of actually the same magnitude, 0.3% expected. And what we find here is, of course, that the internals are significantly skewed by the tariff drama that we've been watching. And we see an absolutely off-the-charts surge in imports that then makes net exports minus imports, appear like a tremendous drag on the overall picture. So we end up with a surge in imports of 41.3%, whereas exports only rose 1.8%. So there is, needless to say, a very sort of idiosyncratic factor here. But if we strip that away, it remains that consumption, which is by far the largest component of GDP, to put this in context, consumption was 68.5% of the total, whereas exports minus imports amounted to about 5%. Exports were about 11%, imports about 15%, and of course the GDP calculation is net of those two. So exports minus imports altogether, we arrive at about a 4 to 5% share of overall GDP, to consumption's 68.5%. So clearly that's the much larger influence. And for consumption, we find that we're growing at an annualized rate of just 1.8%. That is the lowest since the second quarter of 2023. And so, needless to say, the markets do not like this. And what this points to is a weakening of demand in what has been the standout for global growth. And this really is where this gets ominous. The global economy is 58% US, the Eurozone, and China in terms of their share of GDP. The remaining 42% are, for the most part, vendors to the former three. So think Canada and Mexico with the US, or Central and Eastern Europe with the Eurozone, or Australia and New Zealand and many of the world's commodity exporters with China. But with all of that in mind, the data we've just seen over the course of the past 24 hours tell us China remains anemic. The Eurozone is maybe not as bad as feared, but also not much better than it's been. But the U.S. seems to have dramatically slowed. And that, of course, echoes what we've been seeing in the PMI numbers. Since the beginning of this year, this right here is December of 2024, where U.S. economic activity peaks. From here onward, what we find is a dramatic deceleration in the US since the beginning of this year. And the story of last year, where, of course, already from mid-year, China was slowing and Europe was slowing, but the US was clearly holding strong and posting some of the strongest growth levels since early 2022. Here now, the situation has turned. And it's not like China and Europe are catching up to the US. No, it's the US catching up downward to what's going on in these economies. And so we can see here very clearly that what seems to be occurring is the whole of the core of what powers the global economy is trending toward standstill. Now, in particular, when the U.S. GDP numbers hit the wires, stocks swooned. You can see here the S&P 500 spiked sharply lower here. At one point, it was a loss of as much as 2.2%. But by the end of the day, that gets unwound. In fact, less than 2 hours after we hit the lows, we're already starting to claw back higher. And we actually manage a mildly green close here, a mildly positive close for the day. So is it that the markets are afraid of recession, or isn't it? And does this rebound then suggest that perhaps we have a sort of price mechanism that's signaling to us that the markets are actually not that afraid, that the numbers were uncertain, but that ultimately risk sentiment held up and we've shrugged this off? And it's clearer skies from here. Well, not so fast. Because if we look at what has happened with other cyclical and growth-sensitive names and assets, we don't have much of a positive story there. Crude oil is sharply lower today, approaching its recent lows. Obviously, this is energy, and so it makes sense that this would be as hampered as it is if what we're concerned about is global growth. That global growth consumes energy, and you might expect that energy demand would weaken in a downturn scenario. Copper, another bellwether industrial commodity that is even sometimes referred to as Dr. Copper for its sort of early detection of economic weakness. It is shellacked today. Sharp move lower for copper that comes a hair off the lows into the close, but clearly sustains a dramatic decline here as relative to the rebound in stocks. Finally, the bond market shows us that what we find here is a further pricing in of lower rates in the near term. This is the 2-year note, ZT here. This is the most sensitive to near-term Fed policy expectations. And what we see here, of course, is as the bond price goes up, which is what we see here today, the commensurate yield is going down. And that is telling us that we are now baking in the most dovish outlook for policy, at least as far as this is implying, since we were here back at the beginning of April and the markets were freaking out about quote-unquote Liberation Day. And indeed, if we look at what is apparently going on here in Fed policy expectations, what we find is that the markets are now looking at Fed funds futures, baking in 96 basis points in rate cuts this year. That is, of course, a staggeringly dovish view, considering the Fed anticipated half that, about 50 basis points, and the markets themselves anticipated as little as one rate cut at the start of this year. Going back to, let's call it, even as recently as February, the markets only had priced in 25 basis basis points. And of course, over the course of this stock market sell-off, that has built out. But moreover, next year has priced in 32 basis points. And so we've arrived at essentially a 5 rate cut tally, greater by 1 rate cut than the Fed has anticipated. Moreover, looking at the likelihood for what happens next, may, of course, still very much pointing to no change in the rate structure coming at the next policy meeting. But by June, the probability of a rate cut has jumped to 64%, which, if we compare this, let's say, from some of the recent numbers, is something of a dovish adjustment. In fact, just a week ago, it was more like 55%. And so it was basically a coin toss. The market's clearly reading this data today as suggesting the Fed is likely to be more dovish. And why would the Fed be more dovish? Well, because there's an economic downturn that's in the works. And so with that in mind, this kind of resilience in stocks starts to look suspect. And one starts to wonder how it is that other markets, bonds, commodities, they seem to be screaming that there is something of an issue here, and stocks are holding up as well as they are. And some of that perhaps reflects the expectation that the Fed is going to cut, and that these cuts might be coming sooner, and perhaps that is to some extent encouraging. And perhaps that is what's at work, but then you might expect that you could have a better result on crude, a better result on copper, because if rate cuts are going to backstop the economy and the markets believe that, then some of these growthy commodities might look better because the threat to their demand might not be as acute. Another explanation seems to resonate a little bit better, though, and that is the deep stock of event risk on the corporate earnings side this week. After the close, we, of course, had earnings from Microsoft and Meta. They beat expectations, but the markets didn't know that at the time that they recovered their intraday losses. They just knew that there was big event risk that was incoming. Moreover, we have Apple on the menu for tomorrow. So some of these huge names where all of this market cap is built up, the deep, deep concentration names, they're reporting earnings this week. And so it does seem to make sense that if investors are reluctant to jump in front of event risk, that stocks would be doing what they're doing, but everything else would be doing what it's doing. And so stocks here look vulnerable because this resilience seems more tactical than it is substantive. And with that, we turn to U.S. ISM manufacturing data. That's coming out ahead of Friday's NFP report, which we'll tackle on tomorrow's episode in excruciating detail. But here, what we're looking for is for the service sector to contract, and those numbers will be with us next week. The manufacturing component is seen contracting for a second consecutive month, and the pace seen accelerating to the fastest in 7 months. That is the pace of contraction. And again, this is around 50. So this 48 would be a contraction, and that this would be a lower number, sub 50, than the prior month would tell you that contraction has sped up. Now, Citigroup data here is suggesting that U.S. economic numbers are tending to surprise on the downside relative to expectations. That's this negative number on the Citigroup Economic Surprise Index. And with that, we have the risk that the number might even be weaker than expected. And as the evidence continues to mount and the earnings reports that we're looking at continue to get out of the way, the resilience in stock markets seems likely to give way. Now, we may have to wait until Friday's NFP report to get to the full reading on this. But if these ISM numbers are going to end up soggy, the resilience in stock markets may already start to show some cracks. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour Fridays and Mondays. On in just 30 minutes time with Victor Jones for the Price of Truth. Back with Victor on Sundays alongside Tom for First Call. Writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
Hi, I'm the Bat, man of the people. We've recently switched this lady's normal morning show to Tasty Live. Let's see if she notices. I'm just joking around a bit, but our Tasty brand is expanding. Our free 10 hours of daily programming will now be known as Tasty Live. So while things might look a little different on the screen, we're still bringing you the same engaging, probabilistic content that's not offered anywhere else. You're watching Tasty Live, the Traders on Network.
Coming up on Bad Money with Jim Blamer. Blamer's hot stock tip of the day.
Trade ideas? Trade ideas? You're coming to me for trade ideas? I'll give you a trade idea. Trade me for tastytrade.com. Those guys are great. I love those guys.
How we respond to the most difficult situations is ultimately how we learn to build on our successes.
It takes the guesswork out of retail trading.
Having trouble understanding what your trader buddies are saying? Here is what they mean when they say slippage. Every business has costs. Slippage is in reference to the cost to transact in the market and is most associated with the difference between the price you can buy and the price you can sell at for options or stock. If you can buy at $1 and sell at 99 cents, you have 1 penny of slippage. If you can buy at $1 but sell at 90 cents, you have 10 cents of slippage. The more slippage between the prices, the more likely it is to lose out on value when opening and closing positions. This adds up over time. That is why liquidity is so important.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace, and with me today, Dan Cecilia. Dan, what's up?
Not much, and crypto isn't up either. So
yeah, down a little bit here today. We got some more volatility, opportunity to buy the dip, right?
Yeah, definitely opportunity to buy the dip. So I'll be pushing that buy button very soon.
Okay,
but we're still sitting around 95, and I think you mentioned to me earlier, even with all the volatility this month, and all the tariff talk, we're still higher, ending the month higher than we were, end of March? Is that what you said?
Yeah, I believe that is correct. If we want to punch into the platform here, let's just take a look. We're talking about the SPY. We'll look at this on the NASDAQ, look at this on a monthly basis. And yeah, I want to say that despite everything, I'm pretty sure that we are higher than we closed, than where we closed the month last month.
Right.
Closing it this month here, certainly higher than where we opened. So not bad given all the volatility that we experienced. And I think certainly if you had the opportunity to buy the dip in Bitcoin, right? These markets are scary at times. They are extremely volatile. No way around that. But for now, you've been pretty well rewarded if you were able to step in at some of those lows. But that's the hardest thing to do at that point in time too, right? When the VIX is at 50, pushing 60, vol is north of 150. Yeah, it's not easy.
Yeah, but I think, and Kyle, one of person in the chat, was like, stack those sats. And I think if you look at Bitcoin and you look at some of the crypto pairs and how they reacted to this, I think it was a good time to step in and buy, right? I think given the whole tariff rhetoric, given the volatility to traditional markets, Bitcoin and crypto held up decently well, I think. At least Bitcoin did, right?
Oh, absolutely. I mean, we did see an increase in volatility. Right now, Bitcoin vol is basically at a yearly low. We can go through the slides in just a second. But when you look at the move that the VIX experienced, for example, what you saw in equities versus just that same move in volatility in crypto, it wasn't really noticeable in crypto.
Right.
So it held up very well, I think, and probably is looking ahead when you consider liquidity, when you consider easing or loosening of financial conditions in the environment we're likely headed into.
Yeah, I wonder.
It's exciting.
I wonder what's your thought on that though? Like, is it this summer you think we'll see sort of a shift? I know there's like rumblings of tariff deals coming or trade deals coming. I don't know if that'll give some relief, but it does seem like we're headed into that looser monetary conditions, right?
Yeah, I think certainly you have volatility that's a result of those risk-off moves, Liberation Day, the tariffs caught everybody off sides in terms of just how aggressive that initial stance was. But if you go back to February, I mean, the market started to price in what we're seeing now, what was reported this morning in GDP terms, where there's been an economic slowdown underway. You've seen a decline in the rate of change of inflation on a month-to-month basis as well. And so you saw the market start to price that in all the way back to February. Arguably, Bitcoin got it first, right? Led in that case, I think, is leading here into the second half of the year. I mean, if you look at global M2, you look at various measures of liquidity in the financial system, and more so globally, which is really how you have to look at it. You've got to consider what China is doing. You got to consider what the Fed is doing and other central banks. But when you look at that, right, it tends to lead on a multi-month period. And what you're seeing is that you have seen that liquidity impulse to some extent versus at least what we were coming out of at the end of last year. And right on time, you're kind of seeing, the same thing with crypto. You have a weaker dollar at the same time. At the front of the curve, and when you look at Fed fund futures, you're seeing a market that's pricing in lower interest rates going forward. You've seen gold at all-time highs. I think you will see a bit of catch up here with digital gold as well. So I think second half of the year, as it stands right now, we still have a little bit of economic turbulence, I think, to get through. But that said, I think this is something where the conditions and the macroeconomic environment we're likely headed into is much more conducive, at least it has been historically, to higher crypto prices.
Yeah, which is good for all of us, because if you were stacking sats, I think that's what we're looking for, right?
It's good for the Tasty Crypto Show, that's for sure. And I'm not saying that you're going to see that across all assets, right? The S&P might not perform in the same way, but I think in an environment where, let's say you do have a little bit of inflation, you have a slowdown in growth, there is a chase to hedge some of that inflation. You do see long duration assets at times, and crypto specifically, Bitcoin specifically, tends to perform well in that environment, if that's where we're headed.
Right. And I think on top of that, you have regulatory tailwinds too. And like the operating environment or the market environment and appetite for crypto as a whole, Bitcoin specifically, crypto as a whole, is stronger, right? Like, I think with the current administration, I think with the way a lot of the industry players are adopting it, I think that, along with what you mentioned with the economic factors, I think it definitely creates a positive picture of where we could go, in the future here with it.
Yeah, I can't get my charts up exactly how I want them, but wanted to show a little bit of that dollar weakness.
Yeah.
If you really go back over the last, let's look at the weekly here.
What are you looking at, UUP?
UUP is a dollar index ETF, but really looking at the dollar index here, I mean, I think this is clearly one of the longer term drivers of obviously higher Bitcoin prices or crypto when it's priced in dollars. But, these sorts of conditions over longer periods of time are supportive. You kind of have to wonder, like, has something broken as well where there is that real, I would go even beyond an institutional flow, but sovereign flow into this asset. And maybe I'm grasping at straws here, but when you look at the gold buying that's been going on, you look at the volatility in the Treasury market, you look at the weakness in the dollar, you kind of wonder, is this a kind of slow repricing or a reevaluation, maybe a kind of narrative shift almost around dollar-based collateral? And will you see, and I'm not saying at all that this replaces dollar-based collateral in any capacity, but do you see demand for more non-dollar based collateral, more Bitcoin, crypto collateral from some of these larger players over time, right? We want to watch the ETF flows for that. ETF flows are moving, I guess, right. Big inflows.
Right. Yeah. There's actually an interesting website. It's called bitcointreasuries.net where you can track sovereign flow. I don't know if you've ever seen that. I'll drop it to you or
okay, yeah, we'll
drop it in the chat. But that's something you can track, right? Like public-private companies, governments holding Bitcoin on the balance sheet. There's a site out there that they do track it. So, and I do feel as though it is picking up a little bit. So, to your point, there could be a little bit more of a appetite for that, especially from sovereigns as like a non-dollar based hedge, right?
Yeah, I think with the period that we've just gone through and Bitcoin back at 95 here, and given the way that you can kind of forecast conditions over the next 6 to 12 months, anything can happen. But it seems like a market environment in which we're going to take another look at 100, probably move ahead or above it, and I think this is going to run.
Right.
Talking my book, I'm a big Bitcoin crypto bull, but it seems like the setup is there. We're still sitting at a point where we're kind of questioning, all right, is the Fed going to cut? Are they going to be too late? I mean, I think you're getting some signs in the economy that, yeah, the Fed's probably going to be cutting here pretty soon. What does the PBOC do? What do others do? I think everybody's in this kind of same situation where you're going to see certainly more liquidity come back into the market versus where we were. And that's on the margin supportive of crypto and asset prices, generally speaking.
Yeah, and I mentioned this last show that like the way to really frame this market is in periods of risk on and risk off. And I think like if you can be in tune to sort of those indicators or sort of those periods, you can do really well, right? So I think all the stuff you mentioned, that gives us somewhat of an idea that we might be entering back into a risk-on environment. But then if you go deeper and you actually like try and participate in these markets and you get in these discussions and you listen to these Twitter spaces or you pay attention to what's coming out in the news, you can get a really good indication that we're coming back into a risk-on environment. And that's where I think you see Bitcoin. First, it goes to Bitcoin, right? That's what everyone buys. And then I think it goes to some of these alternative assets. And I wonder, is there any alternatives or other crypto that we offer that might, be a catalyst for them?
Yeah, absolutely. I think you're going to see some narratives catch fire, some of those that we've already talked about, right? I do think there's still that catch-up trade on a relative basis with ETH. It's been dead. It's traded extremely poorly. That's been the narrative, but I think that can flip in an instant. We know how quickly this stuff can move. I think there's a catch-up trade with Solana, and I think that you see the emergence of other chains depending on the use cases this cycle. I think it's still very early this cycle. I mean, even if you want to measure it by the, we typically peak at 500 days sort of thing post-halving. We're a year in post-halving, right? I think it was what? April 20th last year.
Right.
So nowhere near the 500-day period. I do think that, again, when price starts to move, it gets everybody's attention. You've been in Bitcoin or you've gotten into that and you've maybe been able to extract the returns there. The next move is only X% versus what people are chasing, and you see people move out on the risk curve, and then you're going to, in my opinion, see things, and maybe you're already seeing this with XRP. At times, Doge can go wild, memes. You see kind of this narrative that catches fire in different parts of the market, things like SWE, et cetera. XRP, I think I already mentioned. You will see more participation in there. Now, that doesn't mean that it's sustained or that it isn't a bubble or anything, but I think that's how you make money, right? Is trying to anticipate where is that flow going to move to next. I don't know which token it's going to be. We're not typically, making recommendations in that sense, but some of the things that I like personally, Solana, SWE, those are kind of really my larger holdings. Stuff that you can't necessarily buy at Tasty Trade just yet, but hopefully you can soon. BitTensor, Tau, I like the AI narrative, but I just don't think that this has really started yet. We saw a flash of it at one point. You go back to kind of December, January, before we really just saw the market take a dump on much bigger factors being kind of that slowdown that we talked about. But that's kind of how I think about it. What do you have your eye on?
I am paying a lot of attention to the AI agents.
Okay.
I'm paying a lot of attention to, meme coins, but certain Solana meme coins, and not so much that like they're just speculative. They are speculative, kind of like lottery tickets. But just how do these meme coins trade, and why do they trade? There's actually a structure to them, and there's actually like a reason why some pump and others don't, right? And there's like this whole kind of trading ecosystem that is centers around some of these alternatives way farther on the risk curve, stuff we don't offer at Tasty Trade, but things I go deep into because I want to understand the market and I want to understand why these things take off and like how to potentially profit off of them. Not saying everyone should trade this. I think sticking with the majors, like you said, the Bitcoin, ETH, Sol, going maybe out to SWE, maybe taking a look at Ripple is fine for if you're just an average trader. But I want to be able to front run these narratives. Like, I think if you think of trading, everyone's trying to front run someone, right? Like, if you really think about how the market works, it's everyone trying to front run someone.
Right, or the broader macro front run the business cycle.
Yeah, exactly. So honing in on a few of these narratives, honing in on a few of these tokens and trying to...
So what are the narratives then that are on your radar? What's got your attention?
I think that AI agents are going to be a massive one. I think that somebody's going to figure out how to create an actual functional AI agent that can basically do everything on chain and execute strategies, execute commands flawlessly, like almost like talking to ChatGPT. That's, trade Solana, bridge over to ETH, like all that stuff. I think somebody's working on that. I think what we've seen before with the past AI agent stuff that you've covered.
Yeah, let's look at, we got AI16Z here.
Yeah.
Maybe it comes back, maybe it doesn't, but a hell of a ride. They all kind of look like this.
Go to virtuals. Yeah, virtuals kind of came back. See, like,
well, I got a little bit of a buy signal there, Dan.
Yeah.
The green, the color has changed, my friend.
Right.
So okay, then let's just dig into that a little bit more. Is it something like an AI16Z, or was that just the catalyst for attention here? I guess, what are you looking at specifically?
Well, on that, I'm looking at more of, I think, what is it, Degen AI there.
This is just the Degen token.
Oh, sorry. What is it? AIXBT is one of the bots.
Yep. Yeah, we used to have that on the watch list here.
I honestly, I know it's going to sound crazy, but Farcoin, just how that's traded, that's probably a big runner. Like, even at $1, probably will get up there with Doge as being one of the main meme coins on Solana. So that, and if people don't know, that's not necessarily like an agent, but it was launched off of two agents talking to each other. So just like those deeper narratives, like those kind of are interesting trades to me, I believe. So
This has been resilient. The fart coin has been pretty resilient throughout all of this as well.
What I found out,
certainly outperforming Bitcoin.
Well, this is what's crazy is what I found out digging into this stuff is there's actually meme coins that are launching that are offering like fart coin emissions or fart coin incentives. So like they'll like launch and get up to like a 10 mil, 20 mil market cap because people are like farming this like incentive. So I don't know, just like there's really deep, we can get in the weeds on it, but like there's really deep just trenches you can get into. But I think taking a look at revisiting some of these, just keeping them on your radar. Sometimes these kind of bounce before other coins do, so might be an opportunity, might be an indicator. I thought we were going to talk about SWE too.
Yeah, let's we can talk about SWE a little bit. Let's pull that one up here too. I think when you go through a lot of these, and we like to put our EMA indicators over this just to get a sense of whether momentum has shifted one way or the other. What I'm seeing is a lot of momentum shifts, if you want to call it that. I call them buy signals or bullish signals here. I think there's a high probability that the bottom is in. You kind of saw that in Bitcoin first. There's the low end of that range. The high end of the range that we've been in has been closer to 110. So we'll see if we can trade back up there. But as you go through just about all of these here, you'll see that you're starting to get that momentum shift out of the bearish environment we've been in throughout this volatility, neutral very quickly, and have since moved into more bullish territory, whether that's L2s like Arbitrum Optimism, here's Jupiter, decentralized exchange on Solana. I mean, all of these charts kind of look the same, but all seem to have some indication. And again, unless there's something that comes out and smashes this back down, but I think we've gotten through the worst of it, which was the surprise really with the tariffs and just how high they were, at least initially at the beginning of the month. There's a lot to work through still. But I think as we've gotten through that, there's again a high probability at the bottom's probably in. This is a lot more interesting to me now than it was when this was all just getting smoked every single day. And that's, true of what we saw in equities as well. But yeah, let's talk about SWE really quickly. This is one on the Tasty Trade platform. This is something that I'm in. I've been in this for a long time. I've been trying to buy the dip in there, and then every once in a while, you get these massive explosions to the upside. This is super volatile. It can go down by just as much, and that's clearly evident by the chart here. But this is something that we've talked about on the show. If we jump back over to our slides really quickly, we've got about 10 minutes. We can run through this, just a little bit of a recap as to what SWE is. And here is the performance dashboard from the morning email, our market update. So if you don't get that, get over to tastycrypto.com and just enter your email address. We send a couple of these out each week. I write them, so, take what's in them with a grain of salt, I suppose. Sometimes they're fairly accurate.
I mean, I make all my trades based on your writings. So
Good luck, my friend. Let's talk SWE really quickly, or is it SUI? No one knows how to say this.
No one knows how to say it.
It's SUI, Dan.
SWE.
SWE. I don't know much about the technology, and I'm not going to claim to know much about it either. There are people that have expertise in this space, but really high level, like what makes this different? It processes transactions in parallel, so a bunch of transactions at the same time versus in sequence. So sequential transaction processing can happen at a really fast rate, but ultimately, when we think about gaming as a use case, we've talked about this before on the show, but ultimately you have to wait in line for somebody else to buy that sword or those transactions to all process. It could happen very, very quickly again, but this blockchain enables parallel execution. Aptos does the same thing. There's others that employ this as well, but that's what's interesting about this is that as a result, high performance chain, cheaper, more efficient, faster. I don't think it's true that it's a Solana killer, but in the same way that the theme, right, the narrative or the investment thesis was, oh, Solana is an ETH killer. I think you can kind of think about some of these as like that's the way you might approach them. Mental framework for it.
Yeah, it's like a Gen 3 layer 1. I'd consider it, right, where it's kind of made some improvements over some of the earlier layer 1s, ETH, Solana. But I think it sits in a different part of the market. I think it is going after general application building, like gaming, more of like a mobile focused blockchain, it's easier to build on. It has more secure.
There's some games that are deployed on it or run on it, use the infrastructure right now.
Right. Yeah. And I think like the big news that came out about this, and I don't know if this is why the price pumped, but Nintendo's Pokemon signed a partnership with it. So Sui is trying to kind of sit in that like consumer blockchain, right? A lot less DeFi kind of focused, or a lot more focused on consumer application, consumer gaming. So I think that they're doing the big push, at least on their marketing front, is bringing on those consumer apps, bringing on those Web 2 brands to build on top of, because what they've built makes it easy to actually create high performant applications, right? So
one of the things that I like to look at to see, is that true, right? Because it's a great story. I'm interested, makes sense. But are we seeing users, or more so, are we seeing activity on chain? A great indication of that, in my opinion, is always going to be stable coins on that chain specifically. So you're seeing this with Solana, right? We've got headlines now. Solana stablecoin market cap at near all-time highs. Same thing with total stablecoin market cap. We don't have a ton of data to go off of here, but this has grown pretty substantially over the last year. I would expect it to continue as long as the space continues to do well, right? As adoption picks up, we've gone from basically zero, or if you want to call it a couple $100 million, to 800 million, on its way clearly to $1 billion in stable coin market cap. If we jump back over to our browser really quickly, we've got DeFi Llama pulled up here, and we can look at some more details around Sui. It does have DeFi. There are those applications, like you mentioned, running on the chain. 1.79 billion, almost 2 billion in TVL there. I think that's real enough, and you can see the growth in TVL across those applications. I think if we scroll down, you can see which applications account for that TVL. So Sui Lend protocol, if you want to speak to that, and you can see the rest of them up here. Again, relatively early for this chain. We'll see if it continues. But these are, the real numbers, real activity starting to pop up behind this.
Right. Yeah, I think there's some positive indication with the stablecoin flow, even just doubling, tripling since over a year. I mean, that's pretty good indication. Yeah, I've been on the sort of like protocol and what's going on the DeFi front on that chain. Sui Lend is just sort of one of the first borrow lend platforms.
Like an Aave.
Like an Aave.
Okay.
It's a money market. And so like a lot of these chains, they launch these things called primitives, and primitives allow this activity to kind of like build upon itself, right? So money markets is the big one, and we have money markets in traditional finance, same idea, right? But each of these chains have their own native money markets. So Sui Lend protocol is offering, deposit rewards. So if you deposit US dollar coin, you can earn 5%, and then you can go borrow other tokens there, right? Now, with borrowing, how you typically do it is, you might deposit at 5% and borrow at 8%, right? And there's that spread, and that's what, you're paying 3%. What happens with these chains is they create incentives, and they juice the returns, they juice the incentives so that you can deposit, so they get TVL, total value locked on the platform, and then they entice you to borrow. And the way they do that is they pay you. So the actual interest rate that you're borrowing at might be positive, so you're earning rewards in another token.
That brings people, it's an incentive, brings people on chain. It's temporary.
To trade. It's temporary.
Right. It's a cost to this ecosystem, or
right.
The labs or whoever's behind it.
Right, but the idea there is it creates activity in the ecosystem, right?
Okay.
So, you want to be capital efficient. You're a trader. You want to take advantage of these opportunities, these incentives.
You might not have used Sui before, but now because there's an incentive, you check it out, and maybe you're sticky. Maybe you go away and you were just there to farm the incentive.
Right.
But a good chunk of people stick around.
Right, exactly. So that's just kind of a nuance to some of these new chains of, I think people will buy the token and not realize that you're really supposed to buy the token, stake it, or deposit it to earn those rewards. And I know we can't do that currently on the platform, but just kind of a little note of how to interact with these chains if you really want to go on chain. So I personally think it's one to keep an eye on. Certainly has the Solana type feel to it. There's a lot of activity. There's a lot of builders. You can see that there's an active money market, and we got almost $1 billion in stable coins on the platform, US dollar coin on the platform, or on the protocol. So something to keep an eye on.
Some positive signs there, for sure.
And that's
price action doesn't hurt either.
The price action doesn't hurt either. Yeah. And maybe there is a pullback. Maybe we get a pullback under 3, and that wouldn't be a bad time to maybe re-enter. I don't know. There's probably, you're better at the technical trading than I am, but
well, I mean, let's look at the chart here for a second. If I'm saying that the bottom for most of this stuff, if I think there's a high probability it was put in at the beginning of April as we went through a lot of this volatility, then the low in there is, underneath $2. Let's call it 175, 180. So underneath 2, if you get back down there, we've seen it kind of move off of that. At the same time, when you look at this, it's been almost $5 earlier in the year, and then we saw the whole market kind of collapse. Everything but Bitcoin market cap dominance, while it did, Bitcoin prices sold off, it was pretty sticky around where it has been. So it's held up, but everything else kind of had a significant correction, as you can see. So maybe this is just a dead cat bounce off of that, and it's going to continue to trend lower. I don't necessarily think so, but I'm also not going to chase this just straight vertical move where we've gone from $2 to basically $4. So do you pull back to 3, maybe kind of mid-range there? We're just eyeing it up. If we jump back to the slides really quickly, we do have the expected move. All I'm doing here is taking the current volatility, realized vol over a 30-day basis, which is 126%, which indicates to me something that's moving up by a lot, because otherwise it can't be above 100% vol in realized terms. You got a price of 342, 346 right now. In the last week, up 30%. Last month, up almost 50%. But here you can see what I'm talking about. This is underperformed Bitcoin, down 18% year to date versus BTC. And in the last 3 months, I mean, the trend for a lot of this stuff still has been pretty bearish. That's why if it does follow what Bitcoin has done recently, you haven't seen the move yet. But that has to happen, right? Expected move off of that 126 vol is 60 cents for the week. So that's 282 to the downside, $4 on the upside. We're coming off of $4 at the top of the range. So yeah, I think you get back down to 3. That's probably got a little bit more, it's a little bit more interesting to me. It's another 10%, 15% down from here.
Yeah. And the one thing too is I want to be clear on some of these tokens. There's supply overhangs, right? So like all the, expected moves, volatility, some of that is great, but there's supply overhangs in that the private investors or the early investors that got token grants, that supply comes on the market in certain times, so selling pressure happens. So there's an unlock coming May 1st. So take a look over the next week to see how this performs, because early, the VCs, the private investors, the team advisor tokens, that comes online. It's linear vested, so that has an effect on price. So I think the next one
call out. Maybe that's why it's pumping into that, right? We're going to be fully transparent. Sometimes this stuff gets pumped ahead of unlock so that people can dump on you at higher prices.
It's really important. It's really important to understand that, because these markets aren't. There's private investors, there's insiders in these markets, right? And it's not illegal insiders. It's just people that invested in the protocol before it went live, right? There's always the VCs, right? Pre-IPO. These tokens don't have the supply, right? The supply doesn't come. It might be $1 billion, but the float might only be 200 million, right. And that float increases as emissions happen over time, right? Emissions being new coins minted or supply unlocks for the private investors.
Yeah, I mean, to that point, so circulating supply on SWE right now is 3.24 billion against a total supply of 10 billion. 10 billion, so you get 33% of the supply is actually circulating. Market cap of 11.3 billion against a fully diluted value, right? If all 10 billion were available in the market to trade in terms of circulating supply at the current price, it's going to give you a fully diluted value of, well, just multiply it by 10 billion. 34.6 billion or so.
Right. Right. I really want to make that call out, because people get ran over on that. They don't realize there's unlocks. So if you are looking at this, monitor it for the next week.
Yeah. Well, I mean, look, the vol is 126 in there. So mathematically, that gives us a 1 standard deviation the low of being at 282. So regardless of where the selling pressure comes from, if it does materialize, that's where you could see this go. We can rerun these ranges each day. But, that's your current weekly 1 standard deviation move. Will put you back underneath 3 if you like this for the long term. Or it was just a, short-term bounce here within this broader kind of bearish trend it's been in since it peaked in at the beginning of 25. But I like the prospects for this if you have a longer-term time horizon. And I've liked that for some time. I own it at lower prices, and I even own it at some higher prices,
Right.
Unfortunately.
This might be one to put in the drawer.
Possibly. Yeah. We'll keep it on our radar. But
Right.
that's going to do it for our show. A little bit on what's going on in the markets, how we're thinking about things at the current juncture, and a little bit of a dive into Sweet. Dan, thank you for coming on, as always. You can catch Dan on Beans as well on the Tasty Crypto YouTube channel every Monday and Friday. So tune in on Friday for, you have the show this week with Shelly out?
Shelly's out. We'll be back Monday.
Okay.
But you could always email me. You can always chat us in Discord. I emailed the viewer the other day talking about Uniswap. More than happy to chat with anyone about this stuff. I want to show you how to be successful in this market and what you can do with it. So,
hell yeah.
Yeah.
All right, we'll leave it there. That's going to do it for our show. I'll be back on Monday. Until then, I'm Ryan.
I'm Dan.
Peace.
So I studied economics and international relations, and I wanted to do the hands-on rather than the academic version of that, and the most natural thing was global macro investing. I begin with a sense of where I think the overall direction is for the macro theme for the next 6 to 12 months, and then look at some basic response from the price action to see how it's going. I think the price itself is the purest of indicator. It subsumes within it the collective emotions of the market. One of my favorite mottos, if you will, comes from the always great Ira Harris, who said, if you're right at the wrong time, you're wrong. And so for me, every macro narrative begins with what's the price action saying, rather than this or that economic indicator or some such thing.
All right, Julia. All right, Nick. All right, Mike. All right, Jamal. All right, Glenn. What was the last trade that you made?
Oh, it was bad.
Oh, man.
I bought SQQQ. It's like a 3x inverse ETF. I feel like I get shit on for the inverse ETF trades. They're not, I wouldn't say they're always good trades, but I'm like, I kind of don't want to get in the options right now, but I want some leverage.
I got long some Apple, and it just happened to work out in the last about 5 minutes here. So I sold a wide put spread out in May, and it basically lost half of its value in the last 5 minutes.
My last trade was closing out a meta calendar spread that was worthless prior to the 500-point rip in the E-minis.
Last trade I placed was I closed out a put spread in SPY. It went well. I regretted to say it was a long put spread that I put on yesterday into the big move, and I closed it out since we retreated in price today, and it's worked out well.
Short gold options.
How'd it pan out for you?
We're still alive, but we're not looking good.
If you don't come from money, working with money sounds like the quickest place to get to money. So this idea of allowing money to work for you was fascinating with me. And then the more I get into it, the more I realized it was just a big competition. You know, it's like a big poker game with really smart people who know game theory, and nobody knows tomorrow, but they're all just taking calculated risk. And when I figured out that's what it was, like it wasn't this weird world of like somebody knows exactly what's gonna happen and this guy's got great stock picks, it's all just calculated risk, that gave me inspiration that like, well, I can do that. So I think spending a lot of time when I was young to learn different option strategies and to learn stocks, options, futures, Forex, crypto, to be able to go where the opportunity is, I think is the most important. Getting hooked in a strategy, it's cool, I respect it, but I tend to think I like to go wherever the opportunity is.
Beat the opening bell. Get trade ideas and market insights before the open. From the creator, Tom Sosnoff, and our chief market strategist, Tom Preston. Every weekday. Sign up at tastylive.com/newsletters.
Oh, yeah, it's Wednesday, April 30th. Last day April, I think, maybe.
Yes.
A little bit after 5 p.m. Central Time, the best time. You know what that means? It's time for Tasty Live's evening show, a little podcast, a little podcast called The Price of Truth, the show where we like to explore the incentives that govern our world and maybe a little bit of price reaction to those incentives. I'm sure we're going to cover both today. Let's introduce our super special guest, the global head of macro here at Tasty Live, Mr. Ilya Spivak. Ilya, how are you, my friend?
Always a pleasure. I'm recovering from what is a very annoying cold that my kids have once again brought from school, but I wouldn't miss this for the world.
You're a good man, a gentleman, and a scholar, a champion. You're MJ playing in his flu game, and I appreciate you playing hurt to come in here and drop some knowledge. Before we get started today, I know we've got a lot to cover, and so normally I don't do a lot of this, I don't do a lot of weird stuff up front, but today is a little bit different, Ilya. I got a 5-year-old son, 3-year-old daughter as well, but my 5-year-old son is sort of in that phase where he wants to know about death. Mm-hmm. So he's asking me questions about death all the time, and I'm like navigating this really weird space of talking about something with a lot of gravity and trying to use very simple words and concepts to convey that gravity or the concept to a 5-year-old. And man, like, it was so much easier when it was like, this is a circle, this is a triangle, this is a square. And very quickly, with exponential speed, I'm now trying to explain the concept of death to a 5-year-old, Ilya. You've been there twice before, have you not?
I've been there once before. My son is 4, so he's not quite obsessed yet, but my daughter is 7, and she's gone through this phase already.
Any advice? Any advice for a struggling father?
I don't know what there is to do but to be as matter of fact as you can about things that are eventualities as you possibly can be, and to try to not make a kind of big deal around talking about it. I know when my daughter was into this, she was like, well, are you going to die? I'm like, well, everything eventually dies. Flowers die. Animals die. Everything eventually dies, but not for a very long time. Don't you worry.
That's such a Russian response. Are you going to die, Daddy? Oh, honey, everything dies.
That's right. That's right. That's right. As the famous Russian proverb goes, hope dies last.
That's so funny. And that's the big difference between, I think, I don't want to make this universal, but it seems like there's a big difference between my wife and myself. If my son goes and asks my wife about these types of questions, she like wants to bury it. Oh, don't talk like that. Don't talk like that. And it's like, no, you can't. You got to talk. You got to talk these things. So you can't pretend like that part of life doesn't exist anyway.
Right.
A little nothing like a little death talk to open the show.
Yeah, nothing like a little scary parenting advice at the top of the show.
Anyway, I promise you, if you just joined us, this is a trading show. Shout out to everyone watching on Tasty Live. That's a cold open, by the way.
How appropriate to be talking about it on after a GDP number like that, huh?
Yeah, I guess it depends on perspective. Let's get to it. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. But if you want to be part of the conversation, there's only one place to do it, and that's on Tasty Live's YouTube channel. So head on over there, and you can be part of this little chat in the middle of your screen, everybody. Did I get it? Did I get it?
Oh, you nailed it that time.
It's not me, it's them. It's production. They're pretty sick at that. And by the way, they totally came up with that. They just noticed me pointing all the time. And it's a pretty cool little gag we got going on. Anyways, I need to get out more. Anyways, if do us a favor, start typing in that chat, get this place rocking, introduce yourselves. And I'm sure we're going to have some strong opinions, but at the end of the day, let's keep it respectful. Everyone has their point of view on the marketplace. At the end of the day, you're either going to make money or lose money. Who the hell cares who else agrees with you? That's my thing. I could care less who agrees with me. At the end of the day, the P&L speaks for itself. Ilya Spivak, there's a lot that we could talk about here today. Let's start with the obvious, the GDP number this morning. Let's talk headline of the GDP. As I'm sure you've done, you've dug into the specifics of the number itself. And then we'll talk price action. There's a bunch of numbers to get to. There's earnings to get to. There's tweets to get to. I mean, we got a ton to cover here. So GDP number, headline, and under the surface. Take me there.
Sure. So headline number was obviously worse than expected. Expectations were for a rise of 0.3%. And what that number is just to be clear what sort of magnitude we're talking about. This is what the economy did over 3 months, and then that rate annualized. So if the economy grew for a whole year at the rate that it was growing in the first quarter, it would rise 0.3% was the expectation, but actually what we got was a 0.3% contraction. And that was, of course, not only a disappointment, it was also the first time in 3 years that U.S. GDP has posted a contraction. And I make a big deal of the magnitude because it isn't just that the U.S. economy contracted over a quarter. It's that if how the U.S. economy performed in the first quarter were extrapolated over 12 months, we'd be looking at an annual contraction in U.S. GDP. And that's a big deal. Especially since the last time, fourth quarter, U.S. GDP was growing at an annualized rate of 2.4%, which is quite healthy. This is a massive downshift.
It is. Let me ask you.
If you look at the headline, but then you start to unpick it.
Unpick it or unpack it? Both. Either works for me.
Both. Why not? Yes. And you start to peel things off and go, okay, wait a minute. Just how bad are these numbers?
Mm-hmm.
And you can make a strong argument for this negative reading would not have been a negative reading. It would still be a very weak reading, let's be clear. But it would have been a positive reading were it
not for those pesky kids.
Yeah, were it not for those pesky tariffs.
Yeah.
Because what you see is an absolute boom in imports, and the way that you calculate GDP, of course, is you calculate net exports. So exports minus imports. And that's your contribution to GDP. And imports surged at an annualized rate, again, of, drumroll, 41.3%, which is an absolutely off-the-charts jump in the pace of import growth. Whereas exports only grew about 1.8%. So, and it's not at all shocking that this happened. In fact, the PMI data from the US and, by the way, from China has been telling you that this is coming. Because with the knowledge that some amount of tariff regime was coming, people obviously started to stockpile and build up inventories of what they could buy, and as much as they could buy, before whatever tariffs took effect.
And this is why
there's a big distortion here in these numbers. Here is sort of the last thing I'll say, and I think that's the upshot in these numbers for me. Net exports is barely a rounding error in the calculation of GDP overall. So yes, this is a crazy surge. And for net exports to be this influential on the headline number is highly unusual.
Mm-hmm.
And the reason that it's highly unusual is because in this last reading, as is in line with historical norms, consumption is 68.5% of the whole. whereas net exports are somewhere in the vicinity of 5% once you net it all out. So yes, this is a crazy swing, but it's consumption that matters for GDP. And when you look at what consumption did in this report, it was the weakest consumption growth that we've seen since about 2 years' time. We'd have to go back to the second quarter of 2023 to get consumption growth that was slower. So, yes, the number looks extreme and scary and crazy, and it's probably wouldn't be so crazy were the tariffs not such an influence, but it's consumption that matters, and consumption looks weak, and that's bad.
It looks weaker, yes. It looks
well,
weaker.
the weakest in 2 years.
Mm-hmm.
The weakest in 2 years.
Would you also say that the last 2 years have been abnormally high consumption?
Oh, sure.
So that's what I'm trying to say. You and I have always said the same thing. Not in terms of
the net contribution.
Agreed.
I mean,
Agreed.
even before COVID, obviously, COVID itself has been a huge distortion on all kinds of things.
Yes.
And we're still kind of working our way around where things ultimately settle. But 1.8% consumption growth, 1.8% annualized consumption growth is weak given where we've been the past 2 years. Is it weak relative to historic norms? Depends what your reference point is. But I think for us here and now, it's the weakest in 2 years, and that's the most kind of relevant look back to sort of see our markets. Do markets make sense relative to what the biggest contributor to growth is doing?
Fair. So I get two things out of that. I mean, more than that, but there are two things I think I want to throw on the table or add to the table. The first is that I think the stories about people being concerned that in 2 weeks store shelves are going to be empty, to me, I think like that's so far, that's going to end up being so far off. And
I agree.
This is one of those reasons why that you can see just how much demand has been pulled forward over these last 3 months in order to prepare for that. I'm not saying that you're not going to see
the inventory numbers in the GDP number are sort of, they speak to what this is. We've been, all of the first quarter was basically importing everything that's not nailed down to build up inventories.
Yes. And so I think, yes, we might not have as many shipments, and all of that's true from all of the logistics people. I would just say be careful over rotating into narratives that the store shelves are going to be empty in 2 weeks. That's number one. Number two
that doesn't look plausible at all.
It doesn't. Number two is, I would say, what the hell is the difference between if you were in a plus 2.4% environment before, and the market had already expected 0.2%. I get that it's a miss, and I get that 50 basis points is a pretty decent, it's a pretty decent swing. Yeah. But in the bigger scheme of things, and the market had already expected this massive slowdown, is it really that big of a swing that this came in at negative 0.3% versus 0.2% in the context of a well-hedged market? So you've got a market that was already at a 25 VIX, which is already prepared for 1.5% swings. And you got about a 2% swing in the majors. I think they pressed 2.5% at their lows on the NASDAQ. But
on the NASDAQ, S&P, I think it was like 2.2.
Yeah. I think this is a bit of hindsight bias, but in fairness, I did explain this very possible scenario occurring yesterday, which is you've got a well-hedged market and a market that's already priced a massive slowdown in expectations from 2.4 to 0.2%. So the headline gets spicier at negative 0.3%. The emotions, the the flutters and the butterflies in people's stomach gets a little crazier.
Yeah.
But in the big scheme of things, did missing by a few basis points for the last 3 months, does it matter as much as what the market thinks about the future? And the answer to that is always no. So explain to me the context of price action, whether you believe it or whether you're fading it going forward.
I'm fading it, and I think the reason you fade it, and the reason that I believe the initial reaction from stock markets, not the subsequent bounce.
Okay.
And by the way, you can't ignore the subsequent bounce. Let's just start there. You cannot look at the market being down 2.2% and then clawing out a positive close and say this is bearish conviction. It's not. That's crazy. This is a massive rebound. And under any normal circumstances, any watcher of the price action, which I am, first and foremost, before any kind of narrative or bias or whatever I may think, the price action has to be king. Because as ever, if you're right at the wrong time, you're wrong. Had tip Ira Harris. So any watcher of the price action would look at the stock market and go, this is a stock market that's not selling off on bad news. And that is tremendous evidence of resilience. You only believe that, though, in my mind, if you look at stocks in isolation today. Because if you look at crude oil, if you look at copper, these are cyclical things. They take a hard whack and they never come back. You look at what happens with Fed policy expectations. The front end, the notes go up, yields come in, a sense of urgency starts to build around rate cuts. To your point, there is a flattener afoot to some extent. The long end ultimately doesn't actually crack down. It ultimately holds. But relative to a long end that ultimately does nothing after a volatile day, the front end of the curve clearly is pulling forward some amount of cuts.
Yep.
Moreover, the tally has grown. We're not just looking at the Fed's 100 basis points or the 50 basis points that the markets had at the start of the year. We are now looking at 150 basis points in cuts. 100 of them this year. That is immediate, urgent. A year faster than the Fed wants to do that amount of easing. And so that to me says every other market except equities took these numbers as negative. Equities did also, but couldn't stick. And so I start to think, well, if equities are the odd one out, why? And to me, it's tremendous event risk on the earnings calendar and a lack of conviction. Because who in their right mind is going to want to front run any of the Mag 7 earnings reports, given how much market cap is in those names and how incredibly influential they are on the overall market? Who's going to be a seller of NASDAQ in the tune of 2%, 1% before Meta and Microsoft? Probably nobody, because then the market is closed. What are you going to do? Get stuck? Why? Then tomorrow, Apple comes up. So you probably have some resilience here just because the market does not want to get run over. But you get to NFP on Friday, and there is no more big tech earnings overhang. I don't know if this market holds up if the number is soft.
What do you think about the flip side, which is basically vol contraction on the end at the end of this week, because you have so many big economic data points, you have so many big earnings data points that while you may be right that may justify a lower price, you also have sort of the tail can wag the dog sometimes, and that option premium and the amount of hedges that are out there, and the fact that you get to the other side with a little bit more certainty and clarity about the things you were nervous about just a week ago, you could get some volatility decay, which sort of gives you an equal but opposite pressure. So how do you throw that in the gumbo, Ilya?
I think that you have to, well, first of all, you have to look ahead to next week and go, we start another macro blitz already on Monday. We have ISM service sector numbers, and those are by far the scarier part of the story. Because manufacturing, let's face it, has been anemic since we got out of COVID. And it's been anemic because goods demand has been anemic. Because everybody splurged on goods demand during COVID because they weren't going anywhere. And there's been this rotation from goods to services. You can see it in CPI, by the way. Goods inflation has been basically non-existent, which tells you there's no demand growth there of substance. There's nothing to pull on inflation. Goods inflation has been basically non-existent for over a year, more. It's all services inflation because all of that spending that didn't get done during COVID has been getting done. And of course, the tailwind of AI doesn't hurt. There's a lot of services spending there. So, but just to stay macro, if you look at what's probably the scariest part of this slowdown episode that we've seen since the beginning of the year, it's that the service sector is weakening and is coming toward a standstill. Tariffs shouldn't be a direct impact on services. Most of that demand is serviced by domestic firms. In fact, it's how the U.S. was so strong last year, while China, Europe, even Canada could not find spillover from U.S. strength, and Canada exports 80% of everything they sell to us. Why? Because it was services, and it was domestic, overwhelmingly. So when you see the service sector now keel over, and you see it happen because business confidence is unraveling, at least if you read the PMIs, right? You can only go so far as you can see. And the PMIs are telling you that the service sector is anemic because people are concerned with the landscape, holding back expenditures and saying, you know what, the fog is too thick, the dust hasn't settled, I'm not going to be any kind of confident. I'm going to be very defensive here. That's what essentially forward-looking purchasing managers at big corporations are saying. And when you look at consumer confidence, you see the flip side of that on the consumer side. So you look at all of this and you go, okay, that ISM services number is by far the bigger story. We're going to get manufacturing this week, but we already knew that was weak. It's expected to be weaker. Okay, yeah. It's been showing us the front running of tariffs for a few months. Obviously, the tariffs are here. Runway's out on the front running. There's nothing else to front run, so that's peeled off. We see it in Chinese PMI numbers overnight. They also had the front running in them. Now that's gone. China's manufacturing sector is shrinking again because essentially whatever inventory there was to build has been built. So now you start off Monday with that, and then by Wednesday you've got the Fed. So there's still tons of macro risk here. I don't see the market as unclenching. Maybe if next week ends with the Fed having come out exceedingly dovish and said, don't you worry, everybody, we've got everybody's cheap money ready to go. We promised you that we'd act if we saw hard data. Well, now we got GDP, that's hard data, and maybe NFP as well, that's hard data. We're going to cut, everyone, and we're going to cut a lot. Or at least send that vibe out there. then maybe, yeah, the market can shrug all of this off. But I'm not sure you're going to get that kind of Fed, because that Fed still is looking at inflation expectations and going, I don't know where these are supposed to go, depending on what the tariffs are supposed to do. Now, when you look at bond markets, they're already telling the Fed what to do. Break-even rates are falling, not rising. So they're already telling you the market is looking ahead, not to the price adjustment from the tariffs, but to what it will mean, which is a loss of demand, a recession probably, but some kind of economic downturn that undercuts demand. So inflation is net lower. But the Fed needs to hang its hat on something concrete. And it's got to find a way to talk its way out of this pause. It wants to, but it's got to be very careful now.
Do you think not having sort of a commitment or a specific roadmap as to how the Trump administration is going to play out this global negotiation, that clearly makes this very difficult for the Fed? Because if they make sort of a commitment in their policy, that's usually like, that's not just we're gonna make one cut and then we're gonna sit back and then see what's going on. Usually it comes in packages of 3, and you can see the market expects 4 cuts. But if they sort of make this move down this path, and then let's say the administration does a 180, they announce a couple of deals with India and everyone else except China, let's say, big deals, and then they go, okay, tariffs off. Well, now you're sort of in this weird situation where inflation expectations could do something that you're sort of not prepared for. So that puts them. Yes. People have said it puts them in a box, but it's a tough thing, and they probably want to be behind the president more than they want to be in front of him, and that's their calculation here, is it not?
Well, I mean, I think they want to be behind in general because the Fed is by its nature a reactive sort of institution. Central banks, by their very nature, are reactive institutions.
Yeah, but they started cutting well before we got to their 2% target back in September.
For maintenance reasons, yes.
Yeah, but that's what it's maintenance in either direction. Not. Yeah, it's like if it's maintenance in September, then clearly you could make the same case for quote unquote maintenance right now.
Well,
given
what real rates
are given what real rates are doing.
Well, you're right, and they have. Right? The Fed came into this year wanting to cut rates by 50 basis points this year and 50 basis points next year. Before the tariffs, before anything crystallized, right? The Fed has been saying, look, inflation expectations have fallen. That inflation expectations have fallen means that real interest rates are going up. If we don't cut nominal rates, then real interest rates with falling inflation expectations, nominal rates minus inflation expectations is real rates, the real cost of money will crush the economy. We don't want that. We don't want for borrowing costs to surge in real terms because we've been successful in anchoring inflation back at least in the direction of 2%. It's a whole lot better than 7 or 8 at the peak of this thing, depending on sort of if you look at CPI or PCE or whatever. We're anchoring inflation in the direction of 2%, certainly well sub 3. And what that's doing is it's cratering inflation expectations before any of this. And so we need to cut nominal rates, or this real rate surge will turn our soft landing pretensions into a nightmare. So the Fed's been wanting to cut. I'm sort of curious as to who is advising the president on this, because it's in the president's interest to just let the Fed do its thing. And the more he goads them, the more they are inclined to wait because they don't want to look like they're kowtowing.
Yeah, my read is he's nervous. My read is he's getting into the middle of a really high stakes negotiation, and I think he's a little nervous. And when he's nervous, he starts he starts lashing out. You know, so on one day to come out and say whatever, the whole termination thing and inspire this whole
real quick
controversy, and then walk it back and say, it's not the worst thing if he doesn't cut. It's like, what the hell was that? And then this morning, stocks are down like 2.5%. And he goes, this isn't my stock market, this is Joe Biden's. I'm like, and then the market takes off 3% from there on a reversal. It's like, this dude's probably watching tick for tick a little bit more than he should. He's clearly nervous.
Yeah.
That's my read anyway. That's my read.
I mean, that's a very plausible thing. The upshot is the Fed wants to be cutting. It's been wanting to be cutting. I think the question is how much. We saw them acknowledge, obviously, in March that what they're seeing in the survey data is scary. But what they told markets is, well, look, we see you, we see what you see, and we need to pin this on hard data because we're not going to make a decision on the basis of business and consumer confidence, because what these swings in business and consumer confidence are tied to are sort of the flood of headlines out of Washington, D.C. And if that turns out to be an easy come, easy go kind of a thing, if to your point, suddenly, and I don't think this is going to happen, but suddenly there's a bunch of there's a bunch of trade deals, and you get religion on leaving the Fed alone, the Fed's going to cut. And markets can unclench, and you get to a place where maybe business and consumer confidence come right back because they go, oh, okay, well, that was scary, but okay, fine. Whatever. We see what this is now.
I think you're going to start getting more deal announcements. I think people are going to be surprised about that.
So here's
starting with India. I think India is the first one, right? That's the one in the hopper.
Seems like it. Seems like India and Japan are close. But here's the thing. If memory serves, the fastest U.S. trade agreement that has ever been reached is U.S. and Singapore in 18 months.
No, I don't think that's the fastest. I think there were others that only lasted 4 months, but the most material ones are like 15 to 18 months, and those are the fastest.
Oh, no. It can take years.
Yeah.
It can take a decade sometimes.
I'm saying the quickest, most material ones have been 15 to 18 months, but I think we've done some sort of trade deals, very small ones, in like 4 or 5 months, if I'm not mistaken.
I would love to see that happen here. I don't have a lot of confidence in that happening.
I don't think so either. I don't think we're going to get like pen to paper an entirely signed deal, but I think you will get MOUs,
like a memorandum
signed.
of understanding, kind of a thing.
And I think the market is going to take that with a grain of salt a little bit, but I think they'll be happy with it. And I think
and here's where I think you've hit the nail right on the head. This is the thing. What are the markets upset about? And we've said this a gazillion times. We'll say it again because it continues to be, I think, one of the most important parts of this whole thing. If the markets were concerned with tariffs as a concept, they would have sold off in November. But they didn't. They're not concerned with tariffs as a concept. They're concerned with how the tariffs have occurred.
I think that's your belief of what the concern is.
No. I think it's not an accident that you don't see the markets sell off until the PMIs turn very dark at the beginning of the year already. And January, they kind of shrug it off. It's 1 month. By February, it's a trend. And when that happens, that's where the markets top. Second half of February. Once the data says that the rollout of the tariffs is having real economic consequences and is a real dampener on economic activity, And since then, you've just seen more of it. More in business confidence, more in consumer confidence, on and on and on and on and on. And so I think if you look at that and you say, well, what the markets don't like is how fungible all of this is. Now, I'm not saying that's not the president's strategy. Maybe it is. But what the markets don't like is the fungibility of everything. And that the reason, and if that's the reason that they're unnerved, then a memorandum of understanding doesn't really solve the issue, depending on what it says. Does it say, well, and this is the idealized scenario. We go back to an average tariff of 2%, and there is no deadline on these talks. We'll iron out the details. In the meantime, back to 2%, which was the average tariff before, quote-unquote, Liberation Day. Okay, that would work. Markets would love that. If it's, we're going to have a deal, blah, blah, blah. In the meantime, it's 10% because that's our new minimum. Tariffs have still gone up fivefold. From an average of 2 to an average of 10. If there is now a deadline on top of this, and you say, oh, well, we're going to reach a trade, there's a pause on tariffs for this long, like sort of the 90-day thing. There's a pause on them for this long. Well, that just creates a new cliffhanger. Are they going to get a deal? Are they not going to get a deal? Well, that's more uncertainty. The market needs to believe that things are stable enough that that businesses and consumers can make decisions with consequences that are quarters into the future, even years into the future for businesses. If these tariffs are going to motivate some sort of supply chain realignment, reshoring, all of those things, those decisions take years to implement. And what the markets need is enough visibility for businesses to believe that they're going to keep sort of building out the things that the president ultimately wants to stimulate. And if there's not visibility, if the way these MOUs are structured, that certainty is not achieved, at least confidence, and things appear not so wishy-washy and fungible, but more stable and certain, if you can't get there, I'm not sure even a trade deal MOU fixes this. It's all about how it's structured.
I think that's probably true, and I think that'll be an interesting test actually for us to come back, if and when these things are announced, and give our assessments on what we thought prior to those announcements and what we thought after. So we'll get there when that time comes. For now, let's deal with the present.
And day of, they probably love it, much as they did the pause in
I think it'll
the 90-day hold.
It'll depend what price we're at, because if the market starts to anticipate it, like Lutnick's already talked about it. I think Navarro today talked about it. So if the market is you're already telling the market that basically you've got something in the bag with India, well, they're going to price it before it comes, before the announcement. So I'm not so sure that you're going to get a big upside response the more they keep basically teasing it out there. You made the point early in the discussion. You distinguish between the initial move and the bounce, but you did it for equities. I want to do the same thing for bonds here, because the initial move for bonds prior to GDP, bonds were floating up higher. I think we were up like 9, 10, 11 ticks, something like this. Not much, less than half a point, I believe. And then at its worst, I think we moved all the way down to, I think we were down 31 ticks. So we were down nearly a full point at its low before rallying, and ended up just negative by a few ticks.
Yeah.
So my question is, if you're willing to believe the first move in equities, I'm curious, what say Ilya about believing the first move in bonds, and what would that mean to believe the first move in bonds? I know it's not a huge move in the big scheme of things, given the volatility we've seen in bonds lately. A 1-point move is not huge. But for a while, the long end did look like it wanted to lift a little bit. What do you think? What's your read through on why that is the case?
That looked to me like a pulling forward of rate cuts, because if you look at what happened in ZT at the front end, it was a very unmistakable move higher. And the curve ended up in a flattener kind of situation. So
I don't get, you said that a few times in the past. I don't get what you mean when you say that. I can understand when usually if you're pulling forward rate cuts, that's going to be between like SOFR and the 2-year, right? Because you're pulling them you're likely in the next 1 or 2 years. The 30 years.
Yeah, but that also means that you need to. It also means that whatever you're doing to boost the economy in that period means that you'll need higher rates further downwind, because whatever stimulus you've done is going to help growth. So you're essentially, what you're saying is that if you do more rate cuts sooner, then rates can be higher in the future because growth will have recovered.
Okay. I guess that's okay. I conceptualize it just a little bit differently. So I understand the way you conceptualize it.
Yeah. So for me, it's a shift in where kind of the blip down in rates occurs and how smoothly it occurs. Is it a lot now, and then that creates inflation downwind as the economy recovers, and then you need higher rates later?
Yes.
Or is it more spread out? And then, I mean, we saw a lot of this when we were looking at even just in February, March, right? The long end really rallied, and that was this idea that the Fed was resistant to cutting, but the market was screaming at them like, "You got to go." And you had this idea that, okay, well, if they're going to delay now, that means they'll need to do more later, and the whole thing is going to be elongated, and rates will be lower later in relative terms. So I sort of look at it this way, because I think if you look at the way the maturity structure broke down, you see ZT had the best day of all. ZN, which is the 10-year, still rose, albeit very mildly. ZF, the 5-year, had a better rise than ZN, but not quite as good as ZT. And ZB, the 30-year, actually had a down day. So if you look at what the curve did from ZT to ZF to ZN to ZB, what you clearly see is a pivot to lower rates sooner. Just across the whole thing.
Yeah. And I think somewhere in there, which is why, okay, let me say two things to the audience, and I would like your response to. There's a lot of people that are operating in this real binary world. And I think some of it, has to do with political bias. Some of it just is what happens when you get into a correction/bear market. People extrapolate to the end of the tail. So like I see this happening a lot with Bitcoin to the right side of the tail. In Bitcoin, what's happening right now is everyone's going, oh my God, this is it. This is the debt crisis, and they can only print. The big print is coming. Bitcoin's going to $1 million a coin. Okay, they go from what you have now and they extrapolate to the very end of the tail to the right side. Then I see a bunch of people doing the exact opposite. They're going, oh my God, we passed these tariffs 100 years ago, the Smoot-Hawley, the Great Depression, and they go to the exact opposite. They go to the very end of the tail. Now, in the long run, either one of those might be right. But I think it's worth reminding people, this is a daily trading show, okay? The odds that tomorrow you get to the end of your left tail or your right tail or at any time in the next 1, 2, or 3 weeks, it's probably minimal. If you're playing every day to the end of the tail, you're going to be wrong more than you're going to be right. I think that I want that to help explain the framing that I have every day coming into the show. It's not that I'm uber bullish. And at times, it's not that I'm uber bearish. I'm picking my spots every day, and I'm playing for either a 1 day, 3 day, 5 day, 10 days thing. And I'm betting that in that 10-day window, you're not going to go to Great Depression on one side or Bitcoin at $1.5 million a coin. And I think that's sort of a trick in psychology that people get stuck in sometimes. And I see it in the comments a little bit, Ilya, and I figured it was worth raising. Regardless if you think that's where we're headed, you might be right. But there's going to be a lot of ups and downs before we get to either one of those points on the curve. Ilya, your thoughts?
You're absolutely right. I completely agree. My time frames are a little bit longer. My average hold for a trade that's a winner is usually 4 to 5 weeks. For a loser, it's maybe 1 to 2 weeks. Because if something's not working, I ruthlessly cut it. But this sort of speaks to this idea that I might have whatever idea I have, but if the price action is not complying, I'm in that for a trade. I'm not in there to sort of lay out capital for either the arrival of utopia or Armageddon. You can't trade that way. So for me, it's the price action.
So then here's my frame. I believe at its best, whatever strategy is coming out of the administration. One, I reject the people that say they're just monkeys pressing buttons and this is completely random chaos.
It's not.
There is a strategy behind it, and at best, that strategy, in my personal opinion, lowers real values of equities. Nominal is a different story. I'll get there in a second. I think at best, it's net negative to the real value of the S&P 500. Then I see the flip side. The opposite force here is that we're running 6 to 7%, depending on what you believe, deficit to GDP. And if we are in a growth slowdown or going into one, whatever this is, then typically, historically, you need to spend more money to support the economy and the people through those periods of growth slowdowns and deleveraging, which means that number could go up. And if that number goes up, that means monetary support, it means fiscal support, and then in theory, you could end up with a situation where nominal prices are rising, though real values may be declining. And holding those two thoughts in your mind at the same time is hard. It's not the typical binary thinking. People get mad and frustrated at you because you're not joining them on one of the polar opposites of their distribution curve where they're hanging out at low probability outcomes. But those two thoughts are what I hold in my mind at the same time. That
I think you have to.
And that's at the best. That's the best possible outcome.
That's the best case
for the administration.
Scenario for this thing.
And there is, I acknowledge, it's a huge gamble, and it does not have to pay off. And there is a big fat left tail on the potential outcomes here. But again, the fatter the left tail on the outcome, the more fiscal and monetary support you get, the more weird things that can happen between nominal prices of assets going up where real value is actually declining. And I think if people are not thinking nominal versus real here, I think you can get in some really funky traps. Your quick response on that, and then we'll move on to another topic.
I think you have to look first and foremost at this entire situation as a regular recession first. And then if that regular recession then creates some sort of dislocation that's more catastrophic, we'll get there. But how has this worked historically, and what is the likely thing? Well, yes, you go into some sort of a downturn. The government backs up the economy, or to the extent it can, with spending. The Fed cuts rates. If the things get really bad, they go back to QE. They start buying assets again. That helps the government to be as expansionary as it wants to be. We saw that during COVID. There was, unlike, by the way, the 2008 crisis, where fiscal policy and monetary policy were at odds. And so the recovery took a really long time. But with COVID, it was a recession that anybody barely noticed, at least as far as like numbers go. It was rapidly there and over because fiscal and monetary policy were both pulling in the same side. The government was spending oodles of money, and the Fed basically said open-ended QE. So I think you have to look at to your point, you have to say, well, until the Fed relents and cuts and starts to really show that they're ahead of where the business cycle is going, there can be speculation on economic weakness. But eventually, you'll get to a point where the stimulus is judged to be aggressive enough. And then asset prices bottom, and you start to go the other way because the markets forever and for all time just need to know that the money will be cheap enough to cushion them from whatever, because nobody can trade for Armageddon, because in an Armageddon scenario, none of this matters.
Gold was down. I couldn't agree with you more. Gold down 1%. I guess we can make the case you can trade for periods where capital preservation means more than capital appreciation.
Of course, yes.
We should throw that out there. But I agree with you. Trading for Armageddon, it's like the idea that you think you're going to trade your way through a horrific scenario, and you're just, it's good luck.
And I'm bearish. But I'm bearish within the context of the financial system survives. Like, we don't go back into the dark ages, which, by the way, is what would be the case if the U.S. were to really have a sovereign failure.
100%.
We're climbing back in the caves.
This is what people, I think, because I'm a prepper, bro. If anyone has gone down the scenario of the left tail, it's me, okay? Let me tell you what none of you have done. None of you have read your clearing agreements. None of you have read your rehypothecation statements. None of you actually understand that none of this stuff is held in your name. It's held in somebody else's name. So in your worst case scenario, worst possible scenario, you've got, even if your account is going up, you've got other stuff. You've got, counterparty risk. You have so many other risks that you need to think through, and those horrible scenarios that you see on the horizon. And I'm not sure people have gone down the rabbit hole far enough to understand how competitive in a world of short dollars, how competitive it will get for whatever remaining dollars or assets or available asset values it could become in those scenarios, and how litigious it could be in those scenarios. I don't think
if the car goes off the road, you sold a bunch of
dude, it's
puts.
every man for
good
himself.
For you. What happens if the market doesn't open? Now what?
I don't know. Yeah. All right. So gold down 1%.
Because that's the Armageddon scenario.
Gold down 1%. Your thoughts on that little move? Are we just basically seeing wiggles within a really tight range and don't think too much about the 1% down move? If so, are you long and or short any gold position right now?
I want to be long. I'm not sure that the pullback is complete yet. It does seem to be anchoring, but I would like it to get out of this congestion and give me a little bit more conviction. I think ultimately we are heading into a scenario that is like regular recession. And then whether we see some sort of other kind of financial architecture consequences is going to have to wait a long time. But in the meantime, it's just regular recession. And regular recession to me means higher bonds, higher gold, weaker dollar, rate cuts, kind of regular stuff. What we saw in markets from mid-February through into March. So I want to be long gold. I think it will reflect those rate cuts. It will reflect sort of the firefighting to the growth downturn. I'm not sure it's fully kind of squeezed out what is essentially war risk. And in this case, it's not a hot war. It's a kind of knee-jerk reaction to a trade war. But we saw this when Russia invaded Ukraine. For a while there, gold spiked. The situation, and this tends to be what happens when the markets don't know what to make of something. Gold is one of those assets where it's like, I don't know what's going on. Let me just put some money over here just in case. It's almost reflexive. And so I think from the beginning of April, you have this really sharp move up in gold that reflects more kind of, oh my God, is this a U.S. sovereign crisis? Kind of a vibe. And I think it's very obvious that it's not a U.S. sovereign crisis. For two reasons. Number one, there seems to be a Trump foot in the bonds, where when you get to a certain level of rates being high, we walk things back. We did it with the reciprocal tariffs. We did it with firing Powell. And that makes sense. The president wants rates lower. It also makes sense why he wants rates lower. He's got an economic reorganization to run through in his mind, and lower rates are needed to cushion the markets through an adjustment. It makes sense why he wants rates lower for what he's doing elsewhere. But when he does things that cause term premium to build up in rates and people get freaked out, it has the opposite effect. It actually drives rates higher. And it seems like they've started to kind of come to that idea. So, number one, since they've come to that idea, I don't think that they're going to step off this idea that they're going to blow up the Treasury market. I think they've learned now that like there is a pain point, and beyond that, they don't want to go. That's one thing. The other thing is, let's say there is a U.S. sovereign crisis. Who exactly is a better borrower, a more qualified borrower than the U.S.? Well, still no one.
I agree with I agree with that statement, but I wonder what you would say to this. I think, could we be moving to a world where it's less, I don't want to say less, like if you were going to buy a gold-backed bond or some asset-backed bond versus something backed simply by full faith and credit, in a world where people are clearly just running to gold itself, and there's more allocation towards a physical thing that I actually own as my base collateral instead of a promise, there's a world where perhaps an asset-backed bond is more attractive than otherwise, than to some extent pure credit.
The problem is, to some extent, yes. The problem is all this kind of thinking runs into real supply and demand constraints.
What do you mean by? I don't disagree. What do you mean by that?
The Treasury bond is a critical part of the global financial architecture. It is baked into every which asset structure as the risk-free baseline everywhere, not just in the U.S. There is just not a deep enough supply of other low-risk assets to replace it. Be it European bonds or Japanese bonds or non-existent asset-backed bonds, which if they were created would still be linked to the supply of gold, which is not liquid enough relative to Treasury. So I can see the share changing. So let's say in the last Bank of International Settlements numbers, the dollar was 88% of monetary transactions, as a testament to how central U.S. assets and U.S. debt are.
Mm-hmm.
You could go to, let's call it, from 88 to like 78, 80, and have a level change where other currencies and other markets pick up some of that. But the U.S. remains by far the leader, and it's just because of unrivaled liquidity and unrivaled depth of markets. There's just nothing comparable.
I agree with you. I'm actually, what I'm saying is not necessarily people will go to buy some Chinese asset-backed bond and that replaces the US Treasury. What I'm saying is, I think I've read a lot of analysis on what Mirren's perspective is or what their ultimate plan might be. And so that Bitcoin reserve, creating a strategic Bitcoin reserve, maybe just part one or phase one of creating or looking more creatively at the asset side of the United States balance sheet. So we talk about the liability side a lot. I think you've even made this point that we have the largest asset base. But the point is that only matters if you have, let me say it this way. You can leverage that asset base by creating asset-backed bonds. So whether it's bonds that we issue that have some underlying Bitcoin collateral or some underlying U.S. real estate collateral, something of this nature.
Infrastructure, whatever.
That can theoretically help to lower U.S. borrowing costs. And you're still dealing with a U.S. Treasury, and it still could be created in this fungible way. So I don't want to go too far.
No, that's absolutely a possibility, sure.
I don't want to go too far outside of my expertise, but I have read some fairly logical and credible ideas for mitigating some of the debt problems we have by thinking creatively about the asset side of our balance sheet and how we might issue debt in the future.
This could absolutely be a part of the mix. My concern is that there's not enough assets that are liquid enough to back enough bonds, but because you need just a ridiculous sea of them to serve the role that they're serving now. But in fairness, if we blow up our trade links, we don't need as many bonds. So it's an interesting kind of a conundrum. But for me, how this boils down to gold is gold, I feel like, has room to correct lower because the sovereign risk thing isn't as crazy as April's move implies, but also that the bias is higher because just recession, rate cuts, regular stuff. And
let me ask you a question.
I want to be long, but maybe not here.
If you owned a store and there's a customer who comes in and he buys 30% of your inventory every month. He's 30% of your revenue, and he's a total dick.
Yeah.
Do you do business with that person?
I mean, you have to.
So when you say things like we blow up all our trade links, I mean, I know that's what it feels like right now. But I think if you simplify this and you just go, the biggest asshole that provides 30% of your revenue wants some kickbacks here and there, what are you going to do?
Well, here's what I think happens. And your point is well taken, which is, again, why I don't think we're in the middle of some sort of sovereign crisis or some sort of Armageddon situation. Because you can't replace the U.S. consumer market. It's impossible. You have to do business.
Or, I mean, you don't have to. You can just be prepared to go into really nasty circumstances. It's
very
either
nasty.
You replace it or you're ready to end the existing world order and go into a dark space.
Well, that's the whole thing. Is like if you break that, we can do The Last of Us, the real game, and and climb into caves, and then the most important assets are canned food and ammo. Like, you could do that, Nobody's interested in doing that, not even North Korea. So I think when you look at then what happens, you're not looking at these, to your point, like extreme tail outcomes. You're looking at level changes within the meat of the curve. So what you're looking at is you're saying, okay, you're not going to get no trade from all the trade. You're going to get a level of trade that was there when the average tariff was 2%. And now you're going to have a level of trade that's there when the average tariff is 10%. And it will be less. It's not going to be zero. It'll be less. And what less means is there are fewer dollars in the hands of foreigners, and so fewer dollars that then get recycled back into the U.S. economy, which makes our interest rates higher, makes borrowing costs more expensive for all involved. So anybody that wants a car loan, anybody that needs a loan on an appliance, all of that faces structurally higher borrowing costs because there's less recycling of dollars into the economy, because that recycling of dollars happens as a consequence of trade. So I'm not saying it's the only thing or even the biggest thing, but it's an incremental change higher to higher borrowing costs.
What would you say to the flip side of that, which is
and that hurts consumption?
Less U.S. debt issuance. So there's less of a demand, there's less supply of debt going to the marketplace out of the U.S., and then likely more debt issuance from the rest of the globe to help offset, to create consumption elsewhere instead of just centralizing that debt creation here in America. And that's sort of a counterweight to the point that you're making.
That seems to be where we're going. But the question is, how much debt can you create in these other places? And the answer is not nearly as much as we can, because these are smaller and aging populations that just cannot create the pool of risk-free assets that we've created. They just don't have the heft.
Not individually, but as a committee, the globe, can create more debt, which can help to offset less debt issuance in the United States.
Sure, and this is why I think you get this sort of incremental change, right? You don't go from an 88% share of for the dollar to nothing. That's, hey, do your farmers walks and practice shooting if that's the environment. Get some bars on your windows. But could you go from 88 to 80? Yeah. And so could you go to 78? Yeah.
Yep.
So incremental, and by the way, within the meat of the curve.
And I think, in fairness, I think that's what I think that's what the goal is. That's what they're trying to do. I mean, if you give them credit for strategy,
I agree. And I think the markets looked at this in November and said, okay, we see where this could go, which is why they didn't freak out about it in November. They freaked out about it later, when the way it was being done started to spook business and consumer confidence and became a dampener on growth.
When they kept putting nuclear Navarro out front.
That's why you're like, Navarro says there's a deal with India. I'm like, oh God, there's no deal with India, is there? Damn.
Oh, that's too funny.
It's almost like when Hassett says things now. He was like, well, the GDP numbers are going to be revised. Yeah, there's a schedule. They're revised 3 times. Have you been so thoroughly contradicted by the president so many times that now you're just saying obvious things because it's safe?
I think all the people who run that National Economic Council, the last guy was a dope too. What was his name?
The one that
under Biden.
God,
I can't remember his name.
It's already fallen out of my head.
He couldn't explain the most basic concepts in economics, bro. They're all dopes.
That would, by the way, that would be the only job in government that I would want. The director of the National Economic Council. Lael Brainerd was the one under Biden. She's formerly of the Fed and before that of the Obama administration. She's savvy, but not on camera. But on camera, she didn't come off like.
I'm not talking about Lael Brainerd. Who am I thinking of? Maybe I'm thinking of a different
savvy,
position.
Lael Brainerd is savvy.
I'll take your word for it. I don't think I followed her enough to follow
Brian Deese, who was there before Lael Brainerd, him I had less confidence in as he spoke. Larry Kudlow, I don't think found.
These guys are all the people that are in that job, they're just propagandists. Yeah. They just like make anything up. They'll just make anything up. They'll say anything.
There have been people in that job that are
not in my adult lifetime.
that are serious people. But just it's really funny with Hassett because he'll come out there and he'll say something and you're like, oh well, this is encouraging, and then Trump will come out like moments later and go, yeah, nah.
Yeah, he hasn't learned how to navigate around Trump. Like, I think Bassett does a really good job of navigating around him.
Yes.
And not setting himself up to be contradicted. But you can see a lot of like less politically savvy people. They'll come out and say something authoritatively without checking, and he will 180 them instantly. Let me ask you this, man. I talked to Chris yesterday about Canada and the results of the Canadian election. I'd like the same feedback from you. What do you think the Canadian election means for U.S.-Canada relations? What do you think it means for the negotiation of trade deals throughout North America? And what do you think it means for the Canadian dollar more broadly?
I think if you believe what the Canadian dollar is telling you here, is that at the very least, this is not bad news as far as the markets are concerned. Now, I know that this was obviously a hard U-turn. I mean, how Pierre Poilievre dropped a 24-point lead in this thing.
It'll be studied. It'll be studied in civics courses for years to come.
I mean, this is one of the great unravelings. He also lost his own seat. In Parliament. So, I mean, this is one of the great political undoings of a career. I think Mark Carney is an incredibly competent thinker and doer and organizer. He's obviously kind of a awkward politician because he isn't one. He's a central banker. I think his experience in times of crisis is tremendous because he guided the Bank of Canada through the 2008 thing, and then he guided the Bank of England through Brexit. And that was a political nightmare. He had to be up in front of Commons committees all the time trying to explain to them this or that. And the Tories were lighting him up the entire time. The Brexiteer Tories. So I think he's very, very capable. I think the conversations he's had with Trump so far suggest their relationship is going to be a good one. Much as Trump's communications with Claudia Sheinbaum is, for all the fire and fury, they seem to get along. And so I think this might be good news for Canada and for the Canadian dollar. We'll have to wait and see. But at the very least, the market didn't think that this was bad. And now we need to figure this out. If the thought process was Justin Trudeau is incompetent and this is terrible for Canada because it's entering into a negotiation with this now pit bull of an American president that's going to press them every which way, just as you renegotiate the USMCA, this might go left. Because Trump is impulsive, and he might slap a bunch of tariffs on or something because he doesn't like a conversation. Carney, I think, is smarter than that, and I think the market is giving him that credit.
Mm-hmm. I do agree with that. I think, I wonder, though, if the Canadian people did not really vote Justin out because of incompetence. I think they voted the consequences of his years in power. I think they voted energy prices. I think they voted
that would be the
interest
incompetence,
rates. I think
the long
they
form
voted,
version.
Well, I guess where I'm going there is, from the outside looking in, I see Carney as the same policies, maybe accelerated. And I wonder if
he's jettisoned a lot of it at this point.
I wonder if in the next several years Canadians will regret voting for a person to oppose Trump in a trade war and instead voted their pocketbook and voted for certain economic outcomes. I wonder. I don't know, but I'm curious 2 years from now how the Canadians will feel.
To me, Carney is first and foremost a pragmatist. And I think he will go to what makes the most sense in his mind rather than something ideological. So I don't see him being the kind of prime minister that Justin Trudeau was, who seemed to just power ahead without really taking the cues and the feedback from the economy, from public opinion to say, you got to correct course, you got to go elsewhere, this isn't, nobody likes it and it's not working. I don't think Carney is that guy. To some extent, Obama was like this, where he was kind of insulated, he had his idea of where he wanted to go, and he was going there. And he wasn't terribly responsive when the people or the markets told him, you got to course correct. Now, in fairness, he had to deal with a different kind of Congress, and this is why fiscal policy was contractionary after the crisis, which was, needless to say, exacerbating of a recovery that took a long time and could have been faster. Justin Trudeau is a much more extreme example, but I don't think that Carney is that guy. I think Carney is a pragmatist, and I think the market so far is giving him credit as such.
I guess there's a sort of irony to hiring a central banker because housing is unaffordable. To me, at some level, like the core of this, that I think there's some irony.
I don't think there's any irony. I think
I know you don't, but
I think there's only irony.
We've always had a fundamental disagreement here.
I think there's only irony if you believe it's the central bank's fault that housing is unaffordable, and obviously
fault is a weird. I wouldn't say it's the fault, but they're
a consequence of the central bank's action.
They're an enabler. They're an enabler of irresponsible government policy. So. Yeah, that's what I would say. I don't know if it's their fault anymore, as it's they enable those that are in power to make decisions that end up with unaffordable housing. Put it that way.
I don't see it that way, obviously. I think central banks have a clearly defined mandate. They live in that mandate. Unless there's some of these central banks that have a fuzzier relationship with the fiscal side, and thank heavens in the US that line is firm. In Canada it's firm. In Australia it's firm for the most part. In the UK it's clear cut. In the Eurozone it's clear cut. In Japan it's a little fuzzy.
Yeah, thank heavens there's a banking cabal that controls our money supply and is insulated from
not insulated
from the voting public. Thank heavens.
It's not insulated from the voting public. It is responsive. It is held apart from the political cycle which is why they're on staggered terms in the U.S., and it's what's enabled our fiat system to survive, where, and we've discussed this before, other fiat systems ultimately caved in because governments couldn't help but print money.
Let me ask you, if you put a referendum out to the United States right now, okay, and on the referendum, it goes in every state. Here's the referendum. On one end, it's recession, 7% unemployment, 25% cheaper home prices.
Mm-hmm.
And on the right, so that's one part. The other part is inflation. It's 3% inflation. Mm-hmm. Housing prices are up by 8%.
Mm-hmm.
And grocery prices are up. Grocery prices on the other side go down too. What do you think? What do you think America, if there was like a high voter turnout for this, what do you think America chooses in that referendum? If a politician would just let people pick, what do you think they would pick?
They choose the recession because I think most people figure that the joblessness doesn't hit them.
They would be right statistically.
Yes, that's what I'm saying.
Most people keep their jobs in a recession. That's what people forget.
Yes. I think they choose the recession because they figure, well, that's somebody else's job loss, but maybe I'll be able to buy a house.
And statistically, that's not bad thinking.
It's not a bad bet statistically, but unfortunately, that's not the situation as it presents itself. For example, in the U.S., housing inventory is 4-to-1 existing homes to new. The problem is we're not building homes.
Yeah.
It's a construction issue. And the first person running for the White House that comes out and goes, what I'm going to do is have a national program similar to the interstate highway system that federally fixes every road and federally builds a massive amount of housing. That person will win in a real landslide, like Reagan-esque landslide, if the people believe that this person can actually deliver and is serious.
I've got a wild plan. I got a wild plan for this. Can I tell it to you real quick before we get out of here?
Of course. Let's go.
Here's the wild plan. You implement a wealth tax, but it's temporary. The only temporary government program that's ever been invented. Okay? The wealth tax. And the wealth tax is purely to create incentives for builders. So there are numbers that we could be building up to. We have capacity to build up to 2 million more homes per year, depending on what studies you look at. Yeah. But there's capacity. We don't do it for incentive reasons, for lots of different reasons. So we are anywhere from 4 to 7 million homes short. So the wealth tax would be a way to say we want to create an incremental we want to build an incremental 1 million homes over the next 4 years. And if at the end of 4 years we've built 1 million affordable homes, pick a number, and adjust it for the cost of living in the cities that you're building these things.
Yeah.
You build an incremental 4 million homes. If you do it, the wealth tax ceases. So what that does is it creates an incentive for capital to oversee the builders who are receiving the money and ensure that it's just not a wasteful government program because they don't want to keep paying this wealth tax. So you have an actual incentive to get to the end of that program and do it in high quality and with efficiency.
It's a good idea. I think it's a good idea. I think there's one problem with it.
What is it?
I think if you listen to people that have tried sort of to throw money at this, or like direct capital at this kind of a thing, what they ultimately run into is the regulation is so cumbersome.
Oh yeah, sure.
That the actual building takes forever.
Of course.
And so,
but that's why I think when you take rich people's money and you say you're going to give it back when this problem is solved, all that will take care of itself. That's my point. It creates all the right set of incentives that will take care of those problems.
I think if you had a real, like, if ever there was a place, by the way, the slash regulation.
It's in California.
It's in built, not even just in California, but of course California is a case in point. But in building, in housing supply. And so if you actually enabled the building to happen, well then, yeah, you could pour capital into it, and then that capital would do stuff on a reasonable time frame. The Biden administration poured oodles of capital into all kinds of infrastructure building, and some of it got off the ground, but not much because it all got tied up in various red tape. And it'll happen eventually, maybe, but all of it is taking forever.
But that's why I wouldn't do direct government basically, I would say it's an incentive program for incremental builders.
Yes.
Building. So then you paying based on results, not based on extending government
I have a
contracts.
similar idea. I would do it through tax incentives.
Exactly.
And things like this. But you have to do the regulation thing because you 100%. Have to, before you get people to run down the highway, you gotta unlock the highway.
We didn't get to, we're already over. I say this every time, Ilya. We could end up talking for 3-hour Joe Rogan podcast, and we'd probably say we could use another half hour. So we're going to have to cut this one short. We didn't get a chance to talk about Meta, but just for the chat here, because I had been talking about this setup, what always happens in these sort of uncertain times is the market will look at Snapchat and they'll do a read through and they'll go, oh, Snapchat digital advertising bad must mean Meta digital advertising bad. But what people always find out, I don't know why they keep falling for this. They always find out that marketers don't cut all digital advertising equally. They cut the dog shit platform first.
Yes.
They will cut their Facebook and Instagram advertisings last. And so the interesting thing is you got a discount in Snap, not a ton, but then GDP put Meta on super discount this morning. And I had tweeted something out like, I can't wait to bet, turn these machines back on so I can bet on Meta in the after hours, for earnings. And, even a blind squirrel finds a nut. So that one's up $30 in after hours. So congrats to anybody that, piggybacked on that one. Hopefully, knock on wood, we get a decent open tomorrow.
Well, and this is why people don't want to front run these earnings, and this is why stocks did what they did, but oil and copper didn't.
Yeah.
To bring it all the way back around.
Full circle. Ilya, if the people want more from you, tell them where they can go.
As always, I am at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. I'm all over the PM part of the Tasty Live broadcast day, overtime, macro money, this show, and I'm on Futures Power Hour midday Mondays and Fridays. And of course, you and I talk to the great and powerful Tom Sosnoff for the open on Sundays.
Ben saying modular prefabbed homes like Deltec, and I threw in Boxable. I keep looking for a pure play on the modular prefabbed homes. I just don't see how those don't just explode at some point in the future. People they're not going to be able to afford these 2,000, 2,500, 1,500 square foot homes anymore. And the only way to deal with the higher cost of materials, higher cost of labor, higher borrowing costs, is you got to build smaller homes, and you got to build them fast. And I don't get all those prefab homes. I can't find a direct pure play exposure, and I want to find one.
If we are going to have some sort of an economic downturn here, one of the smarter things the administration could do is go, we need to provide economic stimulus. Let's provide it by building a bunch of homes. That would be a stroke of genius.
Agreed, bro. I don't get why it's taking so long for people to figure that part out. Ilya Spivak, you're a gentleman, you're a scholar. I always appreciate our conversations. I come away with new perspective, a few laughs, and at the end of the day, I get to reverse some of the brain damage I've done to myself. Add a few brain cells up there. Ilya, I'll see you next week. For all of you out there, hit the like button before you get out of here. Subscribe to the channel if you haven't already. Follow our friend Ilya Spivak on his socials, and do me a favor, if you want to follow the rantings of a madman lunatic, you can follow me as well on Twitter at Victor Jones, Owen Jones @0, because I like to be difficult. We'll see you back here tomorrow, same time, same place, same great network, only on Tasty Live. Till then, peace.